Jai Shree Swaminarayan, everyone. Thank you for joining us for this financial webinar today. Apologies for the slight delay. We had a few technical issues, but hopefully we'll be all good for the next couple of hours. So this is basically the first session we're holding this month as part of the Wellbeing month. So we've got a few sessions going on throughout the month. So we're starting off with financial well-being. We will also have later a yoga session. We'll also be looking at a session which looks at your health and fitness, so your physical well-being. And we'll also be talking later in the month about Alzheimer's and dementia, getting a bit of insight in terms of understanding what that's about, so that we understand how to deal with it when people in our families have it as well. And today we've got 4 special speakers from the different professions within the financial field. So we have someone who has a chartered accountancy background. We have financial advisors who specialize in retirement investment planning, and we also have mortgage advising and insurance backgrounds, and we also have someone from a legal background, so a solicitor who deals with wealth management. So I'm going to leave it with these professionals because we're behind schedule. I'll keep it short, and we'll just get cracking. Thank you. I'll hand it over to Dina. Dina will be mostly moderating the session.
Thank you, Alpesh. Namaste, Jai Shree Swaminarayan to everybody. So today we're going to take you through a typical journey for a family. So before we take you through this journey, I'm just going to introduce the names of our speakers today. So as Alpesh said, I'm Dina Budia. I'm a financial advisor. And I'm going to be predominantly talking about mortgages and insurance today. We've got with us today Suresh Hirani, who is an accountant. We've got today Harish Ragwani, who's an independent financial advisor. And we've got Sangeeta Ben Rabadia, who specializes in wealth management, estate planning, and wills. So as I said, I'm going to take you through this journey. So to take you through this journey today, we've got to have a typical family. So today we've actually decided we're going to have a typical family in our community. So we've got Laljibai and Ganbai Ben, husband and wife. They're actually born, Laljibai is born in India, Ganbai is born in Kenya. They've got their children Pritesh, Maya and Sunil. Pritesh was born in Kenya but moved to UK. Maya, born in Kenya, moved to the UK, lives with the parents. So both, beg your pardon, Pritesh Bai is actually married to Tulsi. They've got children, a 10-year-old and has 2 children. Lives with their family, and Pritesh actually works in Laljibai's business, which is their own company, LK Interiors Limited. The sister Maya, she's married to Jitan Bhai for about 7 years now. They've got 1 child and another one on their way, and Maya's a retail assistant. Sunil, he was born in England, so this is Pritesh's younger brother. He's due to get married to Bhandaben within the next 2 years, and lives with their parents, and he works in banking. So before I go forward, typically the family would be, we're going to focus on Laljibai and his wife, and Pritesh Bai and Tulsi Ben. So they've come to me. They've come to me to talk about their first property. So Pritesh and Tulsi want to move out to their first property because, as I said, Sunil Bhai is getting married, so they've outgrown their house. So what they want to discuss with me is the deposit, where it's coming from. What's actually happening is Laljibai is going to give the money, to Pritesh and Tulsi to buy this house, and they're going to decide, how best to move forward. So a couple of concerns that I've got already is, the money's coming from Laljibai. Where has it come from? How has it been accumulated? Because, when we go to the banks, they actually ask you these questions. So when Pritesh Bai and Tulsi Bai came to me, they were a bit bombarded with all the things that I need to get them to give to me. So generally, I'd be asking for pay slips, I'd be asking for, your loans, how many credit cards, are they paying private tuition fees? They need to understand all the costs involved in the property transaction. So I think sometimes clients don't realize that the amount of information that they actually need from, that I need from them when they're applying for a mortgage. Now, in this scenario, British is actually self-employed, Suresh Bhai. So I generally say to them, look, you need to give me 2 years assessments or 2 years overviews, and I said, you need to go and speak to your accountant. So, Suresh Bhai, what would they need, on your end?
Well, I think from HMRC, they probably need a tax overview, and that basically is a supporting document to support the tax calculation the accountants would have submitted. So when that calculation is submitted, HMRC will say, well, this is the tax submitted and this is what's paid. So that's the tax overview. It supports the calculation that the accountant's done.
Okay.
Now it's just for banks to confirm the two. You get those from either your accountants. Your accountants can log in to their own portals and draw that out. Or you could actually phone up HMRC and ask for tax overviews. So I think that would be the route to get those bits of information.
Okay, so the reason why I need that is on the self-employed, they don't get pay slips, right? Generally, British earns a very low salary. So the banks are going to say to me, you need to evidence their income. So with someone who's working, pay slips and bank P6 is pretty self-explanatory. Someone who's not, it becomes a little bit more complicated. The other thing is, British is a first-time buyer, so we don't really need to worry about this. But your tax assessment also shows me evidence of other income. One of the ones that people or our community, I find that, especially if they've got buy-to-let properties, the rent doesn't necessarily show. So if there was a buy-to-let scenario and the bank says to me, you need to evidence that rent, you need to show me that it's going into that bank statement. But when I'm looking at the tax assessment that you've given me, there's no property income.
Right.
So, Suresh Bhai, that then becomes a problem. Typically what would happen, one of the biggest problems we face, Sangeeta, is that, some of our people have buy-to-let properties and, they're collecting the rent in cash. When they've done that historically, it wasn't really a problem. But now, with digitalization, computers are talking to each other.
Yeah, so the law has changed quite a lot, where lots of different organizations and institutes are talking to each other. So if you have made a submission or, sorry? No? Can you hear me anyway? I've got quite a loud voice. Okay, sure. Yeah. So yeah. Yeah, can you hear me now? Yeah, so as I was saying, what's happening now is that the law has changed so that lots of institutions are actually sharing information. So as you said, when you took out the mortgage for that buy-to-let property, you declared, like for example, when you submitted the stamp duty form, you will have given all the information. So the HMRC already knows that you've got this property that exists in your name. When you went to the mortgage lender, obviously the mortgage lender knows that you're going to be letting out this property. If your information doesn't marry up, in some way you're going to get caught out. And also, I think you probably know this better than I do. If you're then going to say, okay, Marabasa, I've got this AWAC, whether it's Rockra or it's your bank, then having that but not having declared it is no good for future mortgages, is it? Because you can't show it off.
No, absolutely, because it's going back to what we were saying about evidencing income. You can't show it to me black and white. Unfortunately, I can't work miracles, even though I, we say, but and you find that a typical one that I have is, I'm a residential building, I think the interest rate is assessment. Yes. So the interest rate is going to be less. Naturally, it's going to be less, but they don't realize that, but But you know what? The voters roll, when the banks check the voters roll, it's not going to be done by a Rajibhai's name on that. It's going to be, Mr. and Mrs. I don't know, who your tenants are. So that's another alarm bell for the Indian revenue, for the banking sectors. And in this area, specifically in Harrow and Kennington, there's a lot of selective licensing going on. So all you landlords out there, a lot of you have to get a license to rent your property. And one of the forms you've got to fill in with the council, so you have to write who your lender is, who your bank is. You know, people don't realize that that account number sometimes actually tells me that's a residential mortgage, and or is that a buy-to-let mortgage.
And I think what people sometimes forget is that that's actually mortgage fraud. So, and mortgage fraud, it's not just about, okay, if the HMRC find out, we'll just pay penalties and interest to HMRC for not that tax. You've committed mortgage fraud, and therefore that's a criminal offence, and that's not only just a fine, but that could actually mean imprisonment as well, depending on the level of the offence that you've committed.
Yeah. Also, just to bring this up, on a tax point of view, it's evasion. Tax evasion is a criminal liability. So, you're deliberately not paying tax.
And the type of sort of costs or fees if you're doing tax evasion is
it's incredible. Also, it could be, depending on the size of the taxpayer, you could be imprisoned. So, it's not only a liability on terms of penalties. It could be a criminal liability. So, I think that's one we have to be very careful. There's no reason not to receive cash. Cash is a viable payment for that. The declaration.
Yes, absolutely. And I think when you do declare that money, your wealth is growing, right? You're evidencing it, and you get more lending, you can build your buy-to-let property portfolios, and longer term, I think you are growing your assets far more. You know, you'd rather have the money and have it and safe, right? Next one, put up that one. Maybe. Yeah. So, just going back to Pritesh and Tulsi. So Tulsi Benzel actually working. So one of the questions that Pritesh actually said to me was, do I have to add on to the mortgage? She's not working, so we don't need to include her. Right? We need to forecast, we need to think forward and think ahead. So going to you, Sangeeta Ben, for inheritance, for tax, isn't it better or not to have a mortgage going forward?
Well, I think obviously you have to look at the circumstances of what the bishop are trying to achieve, but generally, a husband and wife, if they have the assets, having a 50-50 ownership and lock down all of your assets, irrespective of what they are, generally does tend to be more tax efficient, because it just means that we can do a little bit more moving around, and it just means, for example, on this one, I think, Surya Namaskar will attest to this, if she's not working, and they're not moving, and if it was buy-to-let, for example, it would be tax efficient, not just inheritance tax efficient. So the same thing, so I think, usually when clients come to me and say, okay, we want to do an inheritance tax planning, one of the starting things I do is actually try and balance the ownership between husband and wife, because it just means that there's more tax planning opportunities when the first spouse passes.
Fine, so actually it is possibly better to have Tulsi Ben on the mortgage, even though she's not working.
Yeah.
The other thing, I mentioned that Elijah is actually going to give some money to help Pritesh and Tulsi.
Yeah.
So, naturally the bank's going to say, well, where does money coming from? I can't see it on the bank statement, so I'm going to actually ask for a gift letter. But maybe should say something along the lines of, didn't even have one at it, or what happened with the mother's son. So I got into this dialogue and you can't do that. It's not a loan, it's a gift. So again, we've got to be very careful. And in terms of the tax, in terms of this, they have to sign, right?
Yeah, so what they'll do is when you purchase a property, your conveyancer, whoever's buying the property for you, will ask for that gift or that gift letter for confirmation, because they're out for the lender, so the lender will want confirmation that nobody else has an interest in this property. And if you say it's a loan, then the lender may not allow you to borrow, because they're worried that somebody else might have an interest that's over beneficial for them. So once you say it's a gift deed, to then change your mind and say, I'm sorry, no, it's a loan. Again, that's mortgage fraud, because the lender might not lend it to you if you have declared what it is. You've got to be very careful there. Don't do it. But even going forward, if you then start paying people back, it gets complicated. Like one of the questions that you said is, what if the marriage doesn't work out? Saying to Lajit, like then saying here, oh, Omar, it's not going to work, when Dawson says, well, actually, you gifted it to us.
Exactly. And it's happened, in scenarios that I've had to deal with, divorce rates, separation is happening, this is real. So it's crucial that whatever we're putting down on paper and signing to is what we're actually doing. because, you know, I think a clear message already we're saying is, you know, do not take shortcuts. You know, stick to the law. The law is here to protect all parties, right? Whether it be Lanjava in this scenario or Pradesh, or if there is a separation, the asset overall. So, assuming British then has actually got this mortgage now for me, generally people just say, okay, mortgage thank you very much, and then you know, so it's pretty much a goodbye. But actually the process is a two-stage process. You know, what I actually was very clear with, I think Lindsay went rang me and I said to her that, right, we're taking this 250,000 mortgage out. We need to make sure that if anything happens, have a long-term illness, we need to make sure that this gets protected. I find it commonly with you know, મારી છે ને કે અમે બધા ભેગા રહી એટલે વાંધો નહીં આવે. You know, the mortgage will get paid. I don't need to worry about these things. But, you know, Dulcie was concerned. Dulcie had said to me that, well, if anything happens to Pritesh, he works in the business, he's really busy in the business. I don't work. You know, she's like, I don't work, so how am I going to pay the bills? How am I going to, you know, live the lifestyle that we do? So it's really important that when you are talking looking at taking any form of debt, we are looking to make sure it is covered in any eventuality. You don't want to be financially impaired, okay, especially if you are reliant on each other. Nowadays, we find both parties are actually working. And it's essential that both of them actually look to take insurance. And it's not just about covering the debt. There's children involved in this scenario. There's children involved in many scenarios. You've got to forecast and think ahead. You know, who's going to pay for my private school fees? If my partner passes away, what type of lifestyle do I want to maintain? There's no right and wrong figure with this. It's personal to the family.
I'll give you an example that I've had recently. Unfortunately, I had a client who passed away very recently, and on this particular occasion, the mortgage was just in the husband's name, and the property is just in the husband's name. And they, thankfully, they had insurance, which is going to cover the mortgage. But if, for example, in Tulsi and British's situation, there was no mortgage, this is their residential property, this is where they're going to live. At some point, once you notify the lender that this person has passed away, they won't necessarily automatically say that's fine, that Tulsi can lend, because they've lent on the basis that Pritesh and Tulsi are both joint as the mortgage. And don't forget, if Pritesh is the only one earning, then Tulsi might not be a good enough risk burden for that mortgage lender, so they may say, well, can you pay our mortgage back? So she's dealing with the grief of having lost a husband, and then she's got to find somewhere to remortgage on the fact that she doesn't earn any money and has no viable income, and has to convince the mortgage company that she can continue to pay this, and so therefore to allow her. Now, the client that I'm talking about, slight shortfall in the mortgage because, you know, for whatever reason, slight shortfall. Luckily, the client can pay it off with personal savings, but then now the client's got nothing else left in savings. So they're left with kids themselves, going to have to reduce the hours because they no longer have a partner to support them. And so therefore the income's going to be reduced and they don't have a buffer. They've literally got nothing left afterwards.
So it's going to impact you, not just one on a financial level, but within your family, and not just you, obviously all the family around you. You know, Suresh, one of my classic things that I say to clients, you know, you're happy to insure your car because legally you have to, right? Because you can't drive your car without it. And, you know, Harish, people are happy to insure their houses because the solicitors aren't going to allow you to exchange without buildings insurance, right? But when you go on holiday, people spend ages, you know, booking their holiday, hours upon hours. Kya jasi, kya farwa jasi, let's book itineraries. And then they want to make sure, you know, all their clothes in their suitcases and all their things that they take with them are insured. But one thing the government has not made compulsory, and I hope they do somewhere down the line, Sangeeta, is, you know, why aren't we insuring ourselves? You know, the human being, there would be none of these materialistic things, right? Without, you know, there would be no materialistic things if you're not around.
It's about protection.
Yeah, absolutely. Yeah.
Mm.
So I mean, because it's something that is not imminent. We tend to treat the private families with a little bit of seriousness. We don't actually give it the attention it needs.
Yeah.
So I think in the next slide, when somebody talks about inheritance tax, it becomes very obvious that these are sort of things, a number of actions. So I think protection, you're absolutely right. It is something that, in terms of insurances,
You've got to look at. Yeah, and the only time people talk about it is when they're taking the mortgage the first time, right? But I think they do need to look at things long term. But there's many other, insurance. There's lots of different types of insurances. I think we've got some slides up that are showing, the different insurances that are available. A lot of them are paid as a lump sum. Other thing people are looking at private medical insurance at the moment. NHS lead times, as you all know, especially post-COVID, have even got far worse. So if you want immediate treatment or immediate diagnosis, the private side of, is worth considering. British and Tulsi have now sort of got settled, got their protection in place, but Jitin, sorry, have I got Jitin? It's Jitin, isn't it? I get my brother's name wrong now.
Sunil, yeah.
Sunil and Bhavna Ben are still to get married, right? So we need to, they're still thinking of like, let's get our money together. How are we going to get where my brother's doing, where we're going to get our money. Unfortunately, they may not have access to the deposits from bank of mum and dad. So I'm going to hand it to you, Harish Bhai. Different types of savings could be done quite early on, right? So, what type of things are available?
So, I mean, also we're probably looking at using ISA allowance, tax-free way of saving money.
Right.
Also there's something called a lifetime LISA for short, and that's available to anyone in the 40s where they will get 25% tax relief from the government, subject maximum £1,000 a year. So doing small things in paying on a monthly basis and start building up their savings in cash or investing in stocks and shares. So
when can they do that? What age do they do that?
So in terms of the lifetime or stocks and shares lifetime, will need to be 18.
Right.
By the time you start, but even if they want to start on cash for now, they can always be moved into a stocks and shares lifetime later. And then it just depends on the level of risk. And typically, we'd say if they're going to invest, they need to at least invest for 5 years.
Okay.
Simply because the way markets work, we want to make sure that they don't suffer a loss, for example, when they need the money. So it's just making sure they're comfortable and they're going to be investing for the long term.
So I think there's some poll questions going up on the Zoom. So one of the poll questions that is there is, do you have any of these insurances in place? So do you have life cover, critical illness cover, income protection, or private medical insurance? It'll actually be quite interesting to see what the result is of that. Just see how much of the audience have actually even looked at this. Now, I'm hoping to be pleasantly surprised, but if we're not, it's clearly something that we need to
So I think our technical issues have gone a little bit further and they've attacked our poll question. So I think we're going to have to move on from that one. But there is another poll question coming later on, which will probably address this anyway when Harish Bhai does his bit. So should we just move on to the next questions and just ask?
Sure.
Yeah. But if anybody does have questions while we're talking, by more, feel free just to put it on the chat, and we'll try and answer them as we're going along. So if any of us say anything and you have questions, then just let us know.
Yeah, absolutely, because it's quite heavy content that we're going through.
Yeah, so it's a Saturday night.
It's Saturday night. It's hot out there, so feel free, throw the questions in, and we'll try and answer them as much as we can. So you've covered the savings plan, so they can use this money for the deposit, right?
Yeah.
Future deposits, which is good.
So the lifetime ISA is typically designed to either save for formal retirement,
right,
or also put towards a deposit for a house. So if they want to access the money for the first property, there's no penalties for them to take the money out or loss of settlement. And so it's a good way of building up your deposit. And as you know, cash is probably quite poor at the moment with interest rates. So if you do invest the money, there is a better chance over the long term that your deposit will grow to healthy levels.
Okay, brilliant. Can it be done like lump sum or regular premiums?
Yeah, so they can do lump sums or regular premiums.
Right.
So typically most providers would want something like £50 a month to start off with, or if you had a lump sum, you can pay lump sums in as well.
Okay, well that's reasonable, isn't it? £50 a month is
very reasonable amount to start off with for the younger generation who maybe have a part-time job getting into their first job. So that's good. What I wanted to also mention, actually, that was just coming to play, is some of the questions, Suresh, that people ask me. Actually, I should know because it's a serious question. Actually, is on the event of insurance side of things. People ask me, I don't want to take insurance out. Does that mean that I'm not going to get the mortgage? It's a valid question. So legally, when you buy a house, you don't actually need to take, the protection. Because quite frankly, or on a serious note, the bank doesn't really, they're not actually bothered whether you're insured. Yeah, they're putting their security on the house. So they're more worried that if anything happens to that house, they can get that house back. Hence why it's a legal requirement for buildings insurance, but it's not a legal requirement for the life insurance side. But when you speak to your solicitors or your financial advisors, we're here to protect you. We're here to protect your assets and to protect you. So it's for us to be emphasizing that these things are very key. The other thing that sometimes people say to me is insurance is a waste of money. Or they'll say to me, oh, another monthly, for first time buyers, it can be, a lot of things start adding up. But as we mentioned earlier, the impact on the family is huge. And, with COVID, with the number of losses that we have either heard of or seen in the last year or so, if now is not the time, I think we really need to be looking more at insuring ourselves and valuing ourselves a lot more than our material assets around us, which Suresh you had mentioned. So I'm just going to quickly mention Laljibai in this scenario, because Laljibai is a business owner. So just because I covered insurances on a personal level, there's also business insurances. What's Laljibai going to do if anything happens to him? What's going to happen to the business? Is there an important person in the business? It could be the site foreman. It could be Pritesh himself. There's different types of insurances available on a business front that the business owners can look at. So Laljibai has got a lot of work and a lot of conversations to have. I'm now going to take things slightly ahead, and we're going to talk about sort of the retirement side, Harish, because along with savings and insurance, there's another thing you've got to think way ahead. I know 65 is quite a long way, but it catches up pretty quick, right? Yeah. So Harish, what type of things can they do?
So being a business owner or a limited company, the business can pay a pension contribution to obviously its employees or its directors, and it's a tax efficient way of taking money out of the business, and therefore reduces the corporation tax the business has to pay. And it's a great way of taking money out, saving it for the longer term. So that's one of the key things. Someone who owns their own business should be looking at, especially where Pritesh is employed by the business as well. So it could be a good way of him building up his pension benefits. We know Ganbai isn't part of the business, but she could be part of the business as well. So the business could take more money out to pay into a pension. And the main benefit is that they can build that pot for future generations or for an income. Again, if we're talking about deposits for children, that they could use 25% of that as tax-free to pass on as a deposit for their children. Yeah,
and the pensions, even though they pay it from the business, it'll get paid to them personally, right?
Yeah. So even though the business pays it, their own pension will be personally owned by them, but it's just the business paying in a contribution.
Right, fine. And if you pay into a pension, the government puts money in, right?
Yeah, so personally, if British Buy was paying into a pension, the government would add 20% tax relief onto any contribution that he makes as well. So
do both, right?
Yeah, so he could do both. He could do a mixture, subject to allowances, but he could do both.
Yeah. Fair enough. It's worth you considering, right? Especially as business owners. I don't think a lot of business owners realise that you end up paying less corporation tax, right?
That's right. It's the pension contribution, corporate contribution.
Yeah.
Is a tax allowable expense.
Right.
So it's normally taken as if it's a normal expense of the business.
Okay.
In terms of you don't pay corporation tax on it.
That's
so
brilliant.
it is.
So if they're making loads of profits, it's a way to sort of get your pension, look after yourself for the future.
That's right.
And you've got your pension building up as well.
There are limits though.
Yeah.
And obviously Harish will go through this as to what you can pay. It's not something that you can decide, okay, I made 500,000, I can pay all of it.
No.
There are limits to take care of. Which,
the government's not going to top up too much, are they? No.
And things like that, somebody like Harish who would then work those sums out and say, well, actually, no, you can only put so much.
Yeah. So I mean, generally, we would say speak to your accountant first.
Right.
So I'll say, can you work out the calculation of what can be paid in? Because whilst a financial advisor gives advice, they're not a tax advisor. So we'd always say get confirmation from your accountant, and your accountant can then confirm what can be paid in, and at least that way there's no nasty surprises if you pay in too much or
No, absolutely.
So, because just on that point, it's worth noting that if you overpay, there are tax consequences. So it's not something that if you pay it and then say, okay, well, it doesn't matter. The tax consequences are a lot more aggressive. So you don't want to overpay.
Yeah. So I think there's obviously synergies. You've got to work with the professionals. It's not just one person, is it? So clearly, as financial advisors, we always want to work with the accountant. We're not working against each other because we have our boundaries on what
again,
we can do,
we
right?
If I was advising client, we'd be working with yourself.
Yes.
Or even like Sangeeta mentioned for IHT planning, and there's she'll talk about that a bit later. But there's areas where I might get involved, but I would seek her advice as well before we move on to those type of things.
Yeah, it's like going to the doctor, isn't it?
Yeah.
So you've got the GP, and then you get referred to specialists. Depending on your condition, you then get referred to specialists, and it's actually all those specialists that have to work together to make sure your body is fit. So I suppose we're doing the same on a financial wealth management side of things, aren't we?
And like your GP says, don't self-diagnose using Google.
Don't self-diagnose your wealth side either. Yeah, absolutely. So there's a poll question, I believe, that's gone up. So have you given any thought to retirement? Unfortunately, retirement tends to be one of the last things that people think about, but it'll be interesting to see what you guys think. Do you even contribute to a pension? It could be contribution via your companies or businesses.
Let's see what they have to say about
Or have you even sought any financial advice? So what's the score on that, Sangeeta?
So I think the first question we're going to ask is, have you given a thought to retirement? So before Harish Bhai goes into more detail about retirement, it'd be really interesting to see how many of our delegates have actually thought about it. So you've got a poll out there, very simple, just a yes or no question. We'll give you about 30 seconds, just click one, and it'll, at least that way Harish Bhai will know what we're dealing with.
If they've all got it, we may not even
Completely. Yeah, so we've got results for that. What was the scores out there?
So you've got 50-50 split between having given thought of retirement.
So 50% of you have said, yep, I've thought about the retirement. 50% of you have said that you haven't. Do we have another poll question? I don't know if we've got...
So you've got how many people contribute to a pension? So you've got 60-40 split.
Okay, so for those of you who were asked how many of you contribute to a pension, 60% of you have, 40% of you don't, yeah? And the final question was, have you sought financial advice for any of this?
And 38% have, only, and 63% have not.
All right, that's... Okay, Harish Bhai, you're back in, you get
I'm
to
back
talk.
in, yeah. So, what is retirement planning? So, people usually think of retirement planning as a pension, but a pension is just simply a product. And like anything, it's just a vehicle just to get you from A to B. But actually, when you consider your retirement, there's a lot more to think about. So, where Dina Ben has talked about, property, for example. When I'm looking at retirement planning, I'll be looking at creating a tax-efficient retirement plan, so using other assets that are that the client has. So, we might consider using buy-to-let property because that produces income. We'll be looking at using ISAs or other investments or cash, and also maybe also looking at their pension as well. And the way I would do this is use something called a cash flow model. So what we do with this is plug in all the figures into a system, and then we can stress test the scenario bespoke to the client's situation. So if the client says, I want to have an income of £20,000 a year. Okay, what do you need to do today to make sure you've got that £20,000 worth of income? And what would happen, if certain obstacles happen in your life? So, for example, you talked about protection and death and suffering an illness. Because obviously, if you suffer an illness or death, that's going to impact obviously what you can save and what you can pay in. So we would model that and then explain to the client that this is what you need to do today to make sure you're on plan, or actually you're in a good position and you don't need to do too much now, and we can just need to review it. So, it's not simply just talking about pension, because that's just a product. It's making sure that we're looking at your overall financial situation to make sure that you're, health, you're financially fit basically to meet your objectives in the long run. So we can go to the next slide. So how does actually a pension work? So, I briefly touched on this before, but whatever you pay in, the government will add 20% tax relief back to your contribution. So, if you were to pay £80 in, the government would add £20. So therefore, a £100 contribution goes in. So effectively, the way to look at it is a 20% return on your savings. I know, you already pay tax on it, but you're getting that tax back from the government. And these are one of the, best perks you can get from the government, because the government don't give you much back in terms of tax relief, for example. And then also if you're a high rate taxpayer, you'd probably speak to someone like Suresh Bhai, and he would be doing your self-assessments, and he can claim the additional 20% tax, because if you're a high rate taxpayer, you pay 40% tax.
Yes.
So the additional 20%, Suresh Bhai can claim that back for you, and what that does is that increases the rate of basic tax you pay. So you pay more tax at basic rate than at high rate tax.
Yeah.
So it's more tax efficient for an individual. Also, the growth in the pension is tax free. And also, when you make withdrawals, when you retire, they are taxed at your margin rate, but you can take 25% of the fund value as a tax free lump sum. So there are some great benefits. So, if you're going to have, rental income in the future, other income from other assets, you can actually tailor the withdrawals from your pension to make sure you don't pay too much tax. So that's why what I mean about tax efficient is making sure that, you pay least tax as possible, but you're making yourself as efficient as possible.
So just going back to that, so once you've retired, the income that you draw from your pension, do you have to pay tax on that then?
Yeah, so you will still be taxed at your marginal rate of tax, so it will be classed as like earned income.
Right.
But you get tax relief on the way in.
Okay.
Unfortunately, the government not going to give you tax relief on the way out, so you're going to have to pay some sort of tax. But you can tailor the withdrawals to suit your tax. So if you want to remain a basic taxpayer, then we can tailor that, or we can plan it that way.
Okay. The other thing you mentioned is buy-to-let, because obviously some of the things that people say to me, especially my builder friends or my builder clients, "Mana pension nahi joye, I don't need any pension, because I can atli buy-to-let properties chair," right? But Suresh Bhai, over the years, it's great, because to be honest, I'm a culprit in terms of encouraging them to buy these properties, because that is, bricks and mortar is part of our bloodline, really. But in the last few years, what's happened is, that rent that's coming in, it's, there's a difference, isn't there? They can't just, it's taxed, or, before, I think the mortgage payments, there was something to do with the tax has changed, right?
Yeah, I think what's changed over the last few years actually is that the buy-to-lets have been slightly squeezed out of for tax purposes.
Right.
Now, that's one thing. The other thing is always hedge your bets. Now, property and stock markets generally tend to, Harish Bhai is probably a better person to tell us, but they tend to not follow each other. It's the other way around. When one's down, the other one will be up. So from that point alone, hedging your bets is a good idea. So you don't put everything in one pot. You want to have something, a bit of cash, bit of property, bit of stocks and shares.
Diversification, really, isn't
exactly.
it? Yeah.
The other thing is that if everything is in one pot, you're susceptible to tax changes. Now, this has happened with buy-to-lets.
Yes.
So slowly, all the mortgage interest, you could get mortgage, if you had a big mortgage, you didn't pay tax because the interest was being covered by the rent. Now you can't do that anymore.
No.
It's restricted to 20%.
Yeah. You're going to look at some figures, aren't you?
We'll look at the figures later on.
Yeah,
but
that'll
these
be
are
good
the
to
sort
see.
of things that hedging your bets is a good idea in any case.
Absolutely, absolutely.
So,
Sorry, I should to interrupt there.
So that's fine. everyone will get a basic state pension, long as you paid the minimum qualifying years for national contribution. So a lot of questions, or a lot of responses I get from clients is, the government will look after me, I'll get a state pension, that'll be enough for me. And actually the state pension currently is only worth £179.60 per week. So just over £9,300 a year. And, the state pension at the moment is available at age 68, and, there is talk about it going up to age 70. So, if you're going to talk about retirement and you want to retire early, like 60 or 57 or 65, you're going to have to wait a very long time to get your state pension. And actually, hand on heart, who here could survive on £9,300 a year, when they retire? It's an unrealistic figure. So, most individuals who are employed will receive a pension via their employer. This is called a workplace pension. So you pay 4%, your employer pays 3%, subject to a cap. But if you're fortunate to work for a bank or a large insurance company or a large company, they may pay more into your pension. So if you can match your contributions, it's great, because your employer could potentially pay more in, and that will help your pension pot to grow as well. So there are different types of pensions available. Like I said, typically most of you who are employed will have a pension through your employer. But if you are like Pritesh, for example, wanting to set up a pension for yourself, there will be different pensions that you can, put in place. The basic definition of a pension is just a long-term savings plan. That's all it is. You can't access your pension until age 57. I already mentioned the 25% tax-free withdrawal. Also, it's a great way of passing on funds to children, because the pension is free of inheritance tax, and it's something Sangeeta Ben can touch on. So even, in this example, if Lalji Bhai didn't actually need a pension for income because he's got the company, he's making good profits, and he'll continue work there, he could extract the money from the pension and use it to pass on the funds to his children in the future as part of his legacy planning. So it's a great way of taking money out and protecting it from inheritance tax. And also, just briefly touching on that, you can actually use a pension to buy commercial property. So in this case, with Lalji Bhai, if he did have a commercial unit which he operated from, he could use a pension fund to actually buy it because it's more tax efficient. But obviously this would involve someone like Suresh Bhai getting involved in the conversation from a tax point of view, making sure that we're working together to give the right advice. And actually, if there is commercial lending involved, then we'll be working with Dina Ben, to make sure that we're giving the right advice at the right time to the client, and all our specialisms are being used correctly.
Absolutely. So, in terms of when people want to look at sort of long-term, like the ISAs or the savings, and do you do the same for one? You talked about cash flow modelling. Is the stock market? It's the stock market, right? But is there, for one person, would they put in different money in different funds, or would it be the same for everybody? Yeah.
So essentially, with a pension or an ISA, the underlying investment is it's called stocks and shares, but it's not all stocks and shares. So what it typically comes down to is the level of risk you're willing to take. So you have typically 5 levels of risk. So it starts from cautious, low risk, all the way to high risk. And what happens is, the higher the risk you go up, the higher the equity content that you hold in your portfolio. So typically what we would do is understand someone's risk profile to make sure they're happy to invest. And if they want to take low risk, then that's absolutely fine. And their typical fund would invest into basic asset classes. So 5 basic asset classes: cash, bonds, property, commodities, and equities. So as I mentioned, the lower the risk, the higher their cash and bonds and property content. The higher the risk, they will have more higher equity content. And it's not one size fits all, so it's individual to each person, and it depends on what they're trying to achieve and the level of risk they want to take.
This seems to be quite an in-depth thing. I think Google's not going to answer this, is it, guys?
No.
We're really going to need it.
Yes, I mean, clients can go on Google and self-pick and self-invest, but if they're experts, then great, do it. If you're not, then you're going to struggle to find something, because you have to be aware of a lot of things. It's not just picking a fund, and typically clients will just pick a fund based on past performance, and we know that's not a good guide to future performance, because things change all the time.
Yeah, absolutely. And I get a lot of people, which I'd refer out to you and say, they'll say to me, "My pension makai thatu nathi, it's atlat padhiya hai." It's only increased because when they took it out X amount of years ago, these things have to be looked at, or is it just you take it out and
yes, I'll explain on the slides for you that that it's important to review it, because if you don't review it, then typically you might just get very little growth or nothing's really happened. And that's the importance of taking that advice.
Yeah, absolutely.
Maybe now's an opportune time to actually see what people listening in actually do with their investments?
Yeah. So I think there's another poll question, is there?
Yeah,
Sangeeta coming up?
I don't know if you've already been asked, but if you've been asked, the question was, what stops you from investing? So was it your knowledge, your understanding? Were you too fearful? Was it too complex? Or were you just not bothered, to be fair? So Alpesh, what did we have as results?
45% have knowledge of spending.
Okay.
9% fear, 36% complex, and not more than 9%.
Okay, so 45% of you, so that's almost half of you, said that the reason why you don't invest is knowledge and understanding, and I think that goes to what you've been saying so far.
So
about the need to understand.
because you can go on Google and it will give you a lot of jargon and a lot of information, but it's breaking it down and making sure you understand it properly.
Yeah.
And that's where a professional advisor can help. Just even if you don't take the advice, it's just guiding you basically what your options are available.
I think it's really important for them to remember as well, it's not just a one-time thing, is it?
Yeah.
It's continuous, so you can't come say, okay, Haris Pai kana aja jiawi, and this is a really good, stocks and shares at the moment, invest in it, but it's going to change, isn't it, constantly?
Which I'll show. Yeah. So I've said, unless you're an expert, then you should seek professional advice. Most people tend to go into high cost and poor funds. So they tend to pick funds which are promoted via a provider or a fund that has 12 months of good performance. And the other concern is they follow their friends. So they'll take advice from their friends. Yeah. My friend has said, let me invest into this particular fund. And they go ahead and do it. And a typical one at the moment is cryptocurrency. My friend's done cryptocurrency. Let me put some money in crypto, but they don't understand. Even I don't understand cryptocurrency, and I work in the field, and I have dabbled in it, but it's too high risk for me, and I don't really understand really too much about it. So in terms of investments, if you were going to invest yourself, there are what we call typically two different types of strategies. So you have a passive fund strategy, which just typically follows the market. If the market goes up, your fund goes up. If the market goes down, your fund goes down. And there are active funds which try and beat the market. The returns on each asset class change each year, which I'll show you on the slide on the next page. What a professional would do is look under the bonnet of each fund. So what I tend to do is if a client came to me, someone like Pritesh Bhai, I'd understand his risk, and then I'll look at the funds, and then I'll be looking at the ratios of each fund. So just rather than looking at the performance, I would say, okay, what's the alpha of the fund? So an alpha is how much value has a fund manager added to the performance, and the beta is how much risk is the fund taking. So again, if the fund's giving good returns and it's taking higher risk, then actually, if the market falls, you're going to suffer a bigger loss. So we need to make sure you're comfortable and you understand the level of risk. And these are some of the ratios that I'll do to help make sure that you're in the right fund. So going on the next slide. This is quite a complicated, busy chart, but what this shows you is each asset class and how they've changed from 2006 to 2020. And what it shows you is each asset class has changed every year from being top performing to bottom performing. So this is when Sangeeta Ben said, this is not a one-time deal, this is something that should be reviewed because you need to make sure you're in the right place and you have the right assets, because if you don't, as you mentioned before, Dina Ben, that pension, that client who comes to you say, well, my pension hasn't grown because they haven't reviewed it. They haven't made sure it's in the right place. Yeah. And things are constantly changing in the market. So it's making sure that you're in the right place and in the right assets and you've got the right allocation, because that is the key to successful investing, is making sure you're diversified, so you're spreading the risk, but also making sure that you're taking advice from a professional on an ongoing basis.
Absolutely. I mean, clearly, I think 39% thought this subject is very complex, right? So it is quite a lot to take in.
I'm laughing because I've had clients who say, baju ara bapa hatta and I'm karyu tla me karyu. And then you find baju ara bapa no, it was a success, but no natu, and they don't understand why this was so different. And you end up finding, and it's not just with investments, it's with other stuff that Suresh Bhai will no doubt talk about, I'll talk about, but it's the idea is just because your friend does it doesn't mean you should be doing it, because your friend's situation is different to yours, isn't it?
Yeah, absolutely.
One other thing, Sangeeta Ben, on that is people will tell you of their successes. They will tell you about the failure, right? So if they've not done badly, if they've actually flopped, they won't tell you.
No.
So it's an individual thing.
It's like people don't ring us when things are good. When things are bad, we get phone calls going, and why am I not getting this? So I think the key message from this is what you said about reviewing. I'm going to go back to my medical analogy. As you get older, we have MOTs, we go to the doctor, we get checked again, diabetes thiavi, but cholesterol thiawo, and you get more medication. So actually you've got to do more as your life journey or your family expands. So Lalji Bhai has got his construction company, he's got kids who are moving home, one's retiring, one's saving. So actually as a family, a whole family, there is a lot going on. And they've not even talked about their children and what we should look at, I
think everybody needs to remember, life unfortunately has got a lot more complicated. In this country, it wasn't as complex. You didn't need certain things that you need now. The tax system wasn't as complex. We didn't even have that many assets. We had the Gari Party, for all of the stuff that we're talking about today. But the important thing also to remember is, okay, life has got complex, but there are people out there who can make it easier for you. So going to a financial advisor, going to an accountant, going to a mortgage broker, asking them these questions and saying, right, Harish Bhai, can you manage my pension pot for me? You've got a pension pot. You're not having to do the hard work. Somebody's doing that for you. But as long as you're going and getting that advice.
Yeah, I think, we're very fortunate. The second generation are very fortunate because the wealth has been created. And that those who created that wealth haven't necessarily or known how to protect that wealth, right? So as the second generation comes in, they're fortunate because they've got their own wealth and they've got the first generation wealth. So you're actually making things far worse for the children. Because it's the third generation which are going to be the multimillionaires or laughing, or because there's been no planning, they're actually going to end up with paying a very high tax bill, which inheritance tax side of things. So that's going to be quite topical with this family going forward. So Harish Bhai, we've done sort of the pensions. You spoke about the different asset classes. You've spoken about how this we can look to invest. Was there anything else that we wanted to make?
Yes. So when we're looking at the family, we're looking at young children. And what you can also do is look at junior ISAs. So again, tax efficient savings plans, and these can be invested as well for your children. And also you can invest into a pension for your children called a junior SIP, so self-invested personal pension. So the idea is when it comes to investing, is making sure whatever you do, you're investing in a tax efficient manner. And also the older you start putting money into a pension, the more you're going to have to pay in. So the younger you start, the better it is, because the effect of compounding and you have the long time horizon. And just touching on buy-to-let, a lot of individuals will be thinking about buy-to-let now as a starting point, or should I go into a buy-to-let? And the things you have to consider, we always get a question of buy-to-let versus pensions. And the problem with buy-to-let is you have to factor in all your initial setup costs, solicitor costs, product fees, interest rates, ongoing cost, tax. The yield or the return that you get from your buy-to-let could significantly reduce as well, because once you factor in all the additional costs, you could actually make that in an ISA or a pension on a low risk basis, like 2-3% or even 4%, and it's all tax-free at the end of the day. So but like Suresh Bhai said, it's not putting all your eggs in one basket. It's making sure that you're hedging your bets, and you try and do a bit of everything, so you're not relying on one basically thing to.
So you mentioned the junior ISA and the junior SIP. Is that the parents can invest for their kids, or can the grandparents do anything?
So the grandparents can pay into it as well. So even a junior SIP. So there was an article in the Telegraph that if you started a junior SIP for a child from day one when they were born, and you put £50 a month in, all the way up to they were 45, that would be worth £1 million when they're age 60.
Wow.
So it just shows you that you can actually build up the fund in a quite sufficient way. But so to your question, your grandparents, family members, they can all pay into that junior ISA or a junior SIP.
It's amazing, isn't it? That same £50, if it was spent early on, whether it be pensions, ISAs, or even on the life insurance side of things, the younger that person is, that £50 would get them so much more cover than as they got older, because there's so many different variants to consider.
Sorry, Harish, I'm just going to interrupt you. Before we move on to the next slide, we've had a question, which I think is quite a valid point actually. There are so many professionals out there in each field. What should we be looking for when choosing an advisor? I think it might be worth all of us just having a second just to say what to look for advisors within our own field. So for your field, what is a good advisor?
So all I would say is, from my point of view, whoever you use, make sure they're independent. So there are advisors out there who are restricted or tied. So these are typically ones who work for a bank or an insurance company, and they can only more better suited in terms of make sure you're getting value for advice.
Sure. And Suresh, there's obviously thousands of accountants and tax advisors out there. So what should we be looking out for when we choose ours?
Sastu.
I think it's like any professional, right? So who you can work with. I mean, personal relationship, because it is a personal sort of engagement. So personal relationship is important. Obviously, it's best to have somebody who's qualified in the area that who understands your business. So you need to have somebody who is understanding of one, your family, your business, and somewhat of maybe a professional. So there's no point in going to an accountant if you're a dentist and the accountant doesn't deal with dentists. So there is that value that you get from somebody who's slightly more specialist in that field. The other thing is it's a journey. So an accountant you choose need to understand you and your family, because otherwise how will they advise you on your general taxation matters?
Especially on Laljibai scenario, right?
That's
because
right, yes.
it's extended family and you've got to plan for everybody,
Yes.
right?
So qualified, it's best to have qualified, because that comes a cropper many places. So if you're not qualified, you go for a SA 302 or you guys know that the banks will reject it.
No, absolutely.
Because they need that qualification of somebody to sign that off.
Yeah.
So I think those would be the key criteria on a basic level to choose a professional accountant.
Yeah, absolutely.
I think from a legal profession, if we're speaking in the context of what we're speaking today, it's really difficult because there are lots of solicitors out there, for example, who are perfectly qualified to do the job, who charge various different rates, and working in the profession, obviously cost is going to be a factor, and that's absolutely fine, I think, for all of us, and that's not, I wouldn't say go for the cheapest or go for the most expensive, because that doesn't necessarily relate to the quality of the advice that professional can give. But what I would say is don't be afraid to ask questions. So by attending today, you're giving yourself a little bit of knowledge. So when you come to speak to somebody like me or Dina Ben or Harish, you don't necessarily have to know the ins and outs of it, but you know enough so that when they're talking about it, you have that confidence in that person saying that, okay, yes, they know what they're talking about because I've heard somebody else talk about it. And so I think you shouldn't be afraid to ask questions to your advisors, however annoyed we might get. So, and also, as Suresh Bhai said, it's personable. There's going to be lots of people that are solicitors that are qualified, but you may not get on with me as a person, might not like me as a person. That's absolutely fine. So then you find somebody that you do get on with, and a lot of what we do is generational. So if I have a mum and dad coming to me, typically the children are going to come to me, and when the children come to me, they're going to instruct the grandchildren, this is the lady that you need to call. And so understanding the family across generations is really important, but I think it's also ensuring that you yourself, I don't know what you guys think, but I don't think people should be afraid to shop around. Even if that means that you have a consultation and you pay for that consultation fee, by all means go and have a consultation. And then if you decide, well, actually things didn't really fit well or sit well, that's fine, move on to somebody else. I think you should have that. But then once you are with that person, don't just rely on them 100%. Come to seminars like this, go around, speak, and if you do hear things, don't be afraid to ask the questions. And when Google Bapa is wrong, we will tell you that Google Bapa is wrong. Yeah,
I think also, I encourage people to go and speak. There's many people out there, but it's trust. It's who can you trust? Because that trust has to be a lifelong trust. Yes. Because, sometimes you see people go, oh, my accountant, I've gone to this other man because in a sopan ocha kari didata, which is, I'm like, okay, that's great. But actually the story you told that accountant is not what your aims and goals and what your intentions are with this accountant. And also I think with the work that we do now, that professional you decide to appoint has to be willing to work with other professionals. I think that is really key, because as we are all saying, and we're actually passing the conversation to each other, because we're actually saying, that is not my expertise. And just like we're passing the conversation to each profession, you need to be speaking to each different profession. So I think it's each their own, really, Sangeeta, isn't it? We're not here to say this is the right person. Qualification is key. We're all regulated in our own fields, and check that up. Check that on the SRA website. Check that on the FCA website. But relationships generally tends to be the way we've all grown and what people tend to work with. So I think that hopefully that answers the question on how to choose the professional, right? Yeah.
So so just going back to Lalji Bai and Kanbai's family. So what I've assumed for this scenario is that, and we've spoken about already, that Lalji Bai has a pension of 150,000, and he's told me he doesn't need the money. So first thing we want to make sure is that his wife is being listed as a beneficiary, because she can inherit the pension in the most tax efficient way. Also, we can review his pension to make sure it's in the correct place and it's in the correct risk level. As the pension is inheritance tax free, he can use this for legacy planning, which I mentioned before. If his children require further funds for deposit, he can withdraw the funds 25% tax free as well, which can help them on the property ladder. If he wanted to take income, then we can provide advice and work out the most suitable safe withdrawal rate to ensure the fund doesn't run out. So he's got enough income to last him for 10 years, 15 years, however long he needs that income for, to make sure that he doesn't run out of money. And also, I would have the same conversation with Pritesh, Maya and Sunil around, and their spouses around plans for the future. Because if we're going to give advice to the parents, we want to make sure we're giving the advice to the children, and just making sure they've explored all the options available. They don't have to do everything on day one.
No.
And as you said, it's about building trust, and it's for the journey. So it's just making sure they're aware of things that they may need to look at in the future. And so, and on the next slide, so I've just bullet points, if Kanbai doesn't have a pension, potentially we can have a pension set up for her. The business could make Kanbai an employee. And I said, a stat here is if Pritesh said to me he wants an income of £25,000 per annum today, in today's money when he retires at age 60. So the calculations worked out he needs a fund value of around £650,000. So that's where the cash flow modelling will come in quite important in terms of helping us plan what he needs to save today to get to that fund value in the future, to help him target that level of income that he needs. And I said it might not just be pension fund, it might be other assets that we might start considering to help him build that plan. So again, I'll sit down with Pritesh and his siblings and work out what he needs to do, and then also consider planning for the family in terms of using their ISA allowances and junior ISA allowances and lifetime allowances, etc., to make it efficient as possible. So moving on to some typical questions. I've never invested and I'm nervous about losing my money. So this is what we get quite a lot, questions asked for someone who's a first-time investor when they're investing for the first time. And from the polls you can see that some of our don't have the knowledge, or they're fearful about losing money. So over the long term, investing has proved to be a great way of building up funds. I mean, the funds will go up and down in value. It's just a part of investing. The way I like to look at it is, you plant, let's say, a flower, and ultimately it will grow into a nice, beautiful flower at the end of the day. But in the short term, there could be events where we had heavy rain a couple of weeks ago. That could obviously hinder the growth of the plant or the flower, or the plant receives too much sun or not enough sun. And what that means is we might have to tweak that, adjust the plant. So we might have to take it out of the ground and plant it somewhere else. We might need to give it more water, might need to give it extra, not medication, I don't know what you call it for the plants, but...
Baby bio.
But the thing is, I said, the ongoing reviews and making sure it's in the right place to help make sure, because ultimately it will get to that place where you want it to get to.
Yeah. Just a quick question, something that came to me. Some of our audience may be employed, possibly majority of them. So when they've got company pensions or coming out of their wages, right? So I'm assuming that money goes to these risk investments, or because people, it's funny, isn't it? But when it goes out of your salary, like, it's a deduct payroll, you don't ask any questions, it's just, you get your wage, people may not go into the complexity when it's docked off their salary, but it's actually going into the same type of thing,
so,
right?
So it's going in, so whatever they're paying out from their salary is going into a pension product or from a pension provider, and it's getting invested in the same way as if they were going to do it personally themselves. And again, it doesn't mean you can have your pension with your employer. It's just making sure you review it from time to time. It's in the right place. That's what it's all about. Why do I need a financial advisor? Can I do it myself? So you can. You can go to Google Baba and do it yourself and select your funds yourself. But if you don't know what you're doing, then you really do need to take advice. So Vanguard, who are one of the world's largest asset managers, stated that a financial advisor adds around 3% per annum returns if you take financial advice. So that's quite a lot of money being added if you're taking financial advice. Also, a financial advisor stops you from making mistakes, which I'll explain on the other slide. But a role of a financial advisor isn't just to give you advice, it's to help you coach and build up your knowledge, to make sure you understand what you're doing. Because there's no point of, you go, here's my money, you put into a pension, and I don't really know what's going on. You need to understand what it's doing, because it's your money at the end of the day. Okay, so this slide here shows you every single recession, and I'll have to zoom in, from 1925 to 2018. And what it shows you is after each recession, the market has recovered. So again, a financial advisor, if we were looking at March last year with COVID, the markets fell to world record lows. And a lot of individuals would have panicked and maybe put their investments into cash or taken the money out. And a financial advisor would have said, no, leave your money where it is.
That's typical, isn't it?
And leave it where it is. And actually, those who left their money invested after the falls in March or put more money in, their actual returns have been, record-breaking returns they've achieved over the last 12 months. We've seen funds return, over 100%. And this chart just shows you that, the key is not to get nervous and make rash decisions. It's to take professional financial advice. A good financial advisor will sit down with you. You can explain your fears to them, your concerns, and then they'll explain to you why you should remain invested. As long as you've got the right asset mix, the right funds, and it's been reviewed, you shouldn't need to worry, and it will recover. And
it's
that's
timing, isn't it?
Yeah.
It's like, if we're in a recession, you're not going to sell your buy-to-let property, you're not going to sell your house, is it? Or to title which one? It's actually paper money. It's just the value of it is just going up and down. The real loss or gain is when you cash in, right?
And that's where the financial advisor will say, actually, it's the wrong time to cash in at the moment. You might need it to recover, or if there's an opportunity, you can put more money in. But it's just saying, don't panic. Don't make rash decisions. If you are worried about losing money, if you taking professional advice, they will hold your hand, and they'll make sure that you don't get nervous and you can sleep easy at night. That type of thing.
No, absolutely.
So the last few questions I normally get is, the government will look after me. Well, if you can survive on £179 a week, then great. But if you can't, then you need to plan yourself. The government will only help you so much, but the rest of it is down to you. And I said, you're inheriting wealth from your parents, is make sure you're protecting it and then building it for yourself, for your future and your children. And will I lose my money? Again, if you're taking advice and you invest correctly, you won't lose your money. Which is what history has shown, unless if you're going cryptocurrency, which is a different story. But you can't time the market, but you can. It's all about the time in the market. The longer you're invested, the longer you stay invested, the longer you take advice, and you're in the right strategy, your portfolio will do well. And as long as you're reviewing it, you can't go wrong. And it's all about the risk you're willing to take. That's what it comes down to.
Yeah, absolutely. And you can change that risk, right?
Yeah.
So sometimes when you're younger and you're still saving or whatever, you might not want to take as much risk.
So typically a first-time investor would start with a low risk, and then as they get comfortable and they get the experience and knowledge, they would move up slightly higher risk.
They see the money, right, Harish?
And then as you start retiring or coming closer to retirement, you start de-risking and taking less risk, because you don't want to put too much of your money at risk.
No.
And that's the key after.
Yeah.
It's not being greedy. That's what it's about.
Yeah, absolutely. Wow. So we've now made our pension. We've got loads of savings. We've got our tax-efficient ways of investing. This is while we're alive. So while we're alive, we've got all this money, but what are we doing? Typical answer that my parents would say to me, So
spend it, to be honest.
I'm trying to encourage them to spend it. But that's the type of answer I get, Sangeeta. So I think it'll be interesting to see how we're going to encourage our parents to give apro. Look, a taxman might take something. So I think you need to take over now, Sangeeta, and actually illustrate how these things the taxman can.
So Saturday night, 9 o'clock, I need to keep you all engaged with tax. Okay, right. So what we're going to do is we're going to, for this purpose, I'm going to stick to Lalji Bhai and Khan Bhai's scenario, because it's probably just more illustrative of a typical scenario that you'll face and something that will be more applicable to you and your families. So far, Dina Ben and Harish Bhai have been talking about what you do during your lifetime, how you can make your money work during your lifetime. What I'm going to talk to you about is what we need to do, or how you can make things efficient if and when you die. Well, when you die, okay? Whenever that might be. Yeah, there is no if, yeah, you know. And unfortunately, we do live in a society where you're going to be taxed on everything. The key is not tax avoidance or evasion, more mitigation. And so inheritance tax is one of those things. I have a lot of clients who come to me and say, unfortunately, we don't live in a society where you can get away with paying 100% inheritance tax. Sometimes you can, and you can do it legitimately, but don't expect there to be miracles if you've accumulated wealth of millions and millions. And given that, I've noticed most of our those who are listening in today are most London-based. Now, if you think about your house and the value of your house typically, then if you're London-based, your asset portfolio, you have one residential property, maybe a buy-to-let and some savings, maybe you've done well with your pension pot, or you know, you've listened to the advisors today and you've actually built your wealth, then typically you're going to have an asset portfolio that is at least over £1 million. And so you're going to have to do some form of tax saving when it comes to, in terms of, okay, I want to pass on the wealth to my children, grandchildren, whoever it may be, but without having to actually pay all that tax. So what we're going to look at is we're going to look at Laljibai and Ganbai's assets, okay? Here, this is probably, I think, in terms of the clients that we see, this is a typical, what I would call a Garmbi client, in that this is the sort of clients that will come to us. They have a residential house, maybe have buy-to-lets, a business, construction business, some stocks and shares, some cash in the bank, and a few liabilities. So for our purposes, we have got Ganbai and Laljibai together. Our net worth is just under £2 million. Okay? And what the government will do is when Ganbai and Laljibai pass away, they'll say, right, what were they worth? Can I please have a slice of the pie? All right? As unfair as it is, they have basically the audacity of dying means that they think that they deserve 40% tax.
No one's talking about material and the value of material. The only time you've got value is on death, right? So all of a sudden you've got a price put on you at death. Yeah. You know, all this time.
You're worth more dead anyway. That's
clearly.
Yeah. And so what the government says is, we want to know if you've been living in the country if you've been in the UK for more than 15 years, which most of us have, then the government will want their inheritance tax on your worldwide assets. So that means Indiana, Kenya, Australia, US, Cyprus, Dubai, wherever you have assets, they will say that gets included, even if you have to pay tax in those jurisdictions as well, okay? So, and the rate of it is a flat 40%. So for like for example, income tax, the higher you earn, the more you pay. With inheritance tax, is 40%. But you do have some reliefs that come out before that, okay? And so the main exemptions or reliefs are spousal exemption. So if Laljibai passes everything to Ganbai, there will be no tax to pay, okay? If there's something called a nil rate allowance, everybody in the country, the same way you get a personal allowance for income tax, which at the moment I think Surya is what, 12.5 grand roughly? Yeah. So right. For inheritance tax purposes, you will get a lump sum of £325,000 tax-free, or rather your children will, and then the government will say anything you own above £325,000, can we please have our 40% tax on that? Another allowance that's come in a few years ago is called the residential nil rate allowance. There's lots of terms and conditions attached to this one, but if you do qualify for this allowance, which typically a lot of us will, because it's basically owning a residential property and passing it on to your lineage, so your children, you will get an additional £175,000. So what that means is that one person can potentially get, or their assets could potentially be exempt of tax up to £500,000, and anything above that will be taxed at 40%. And if we look at Ganbai and Laljibai scenario, their residential home alone is worth £1.1 million. Okay, so whilst they'll have some allowances, they're not necessarily going to get 100%. Then you have gifts of charity. So any gifts that you make to charity when you die, if it's registered with the HMRC, then that will be tax-free. So that doesn't get calculated. So for example, if you do donate to the mandir, okay, then that gift will be tax-free. If you're thinking of doing donations to Bhuj Mandir India or to any other overseas charities, then what you need to try and do is put a gift to their overseas branch here in the UK with the
UK charities.
Yeah, it's got to, well, it doesn't have to be UK charity, it just has to be recognised by the HMRC as a charity. So it needs to have a HMRC charity number. Okay, so for example, if you are thinking of I've had clients who want to benefit other mandirs or other charities abroad, especially in India. That's absolutely fine, but we need to then look at ways of doing that via a charity here in the UK. Okay, and then there's something called lifetime gifts. So the idea is you can gift away some of your assets during your lifetime, and if you live for 7 years after the date of that gift, then the government won't ask you to include that in your calculations. Again, there are terms and conditions attached to that, but that is one of the options that are available to you. Now,
sorry, Sangeeta, I just want to ask a couple of questions there. So the gift that Lalji Pai gave to Pritesh to buy that house, would that the 7-year thing?
Yeah. So so how much did we say? How much he was gifting?
I think. Well, let's say 100,000.
Yeah. So let's say he's gifting £100,000, and he's gifted it today. So today is what, the June 2021, right? He would need to survive until June 2028 in order for the government to say, okay, we don't care about that gift. But if Lalji Pai died within that 7-year period, the government will want to know that Lalji Pai made that gift. Okay, that's not necessarily to say there will be tax payable on that gift, because there are tapers, as I said, there are terms and conditions, but just that they will want that declared, and then that will have to be included in the calculations. And sometimes it doesn't make a difference, sometimes it does end up meaning that you have to pay a little bit more tax.
Just to add on to that, this is where it comes back to saying gift with reservation. So if you gift it, gift has to be outright.
Okay.
So you can't say, I'm going to give you this house, but I'll continue living in it. That doesn't count as a gift. Or I'm giving you 100,000. Lalji Pai says, I'm giving you 100,000, but tu man pasha de de. That doesn't count.
Okay.
So the gift has to be outright without any reservations.
Right.
Yeah, and the typical gift with reservation that we have in our community is if we've got Lalji Pai and Kanbai say they're going to plan on living with Sunil, say Sunil lives with them a long time and says, oh, Sangeeta mane tax nati bharu too much, Sunil na naam na makan kari nakhuke, Pritesh no naam add kari nakhuke, I'll add my children's name now, ameresu, but I won't have to pay tax. That is what Suresh Bhai is talking about with gift with reservation of benefit. The government has picked up on that. They know you're trying to essentially scam them, is the way they see it, and they'll say that you're still benefiting from that asset, and therefore that asset still belongs to you in kind, and so we want it. The only way you would be able to prevent that is if Lalji Pai and Kanbai then paid a full market rent to Suresh for living in that property, Sunil, sorry, for living in that property. So you have to be really careful, and this is what we're iterating today about take professional advice. Just because the neighbor next door did it doesn't mean that we did it. I have had a client who say, amara baju ara chene ena dikra no naam nu kari nakhyu tu atle inheritance tax na bharu paryu na capital gains tax na bharu paryu. And I said, well, I obviously wasn't the advisor, didn't know what was going on. After about 30 minutes of him insisting that he could transfer his property to his son without there being tax, because he knew better, turns out they actually lived in that property and they occupied the property and they were benefiting from the property, whereas his property was an investment property and they hadn't lived in it for years, and so therefore the tax treatment was very different. Yeah, so it's really important that you don't rely on just what others are saying. Obviously come to us for advice and say, look, this has come up, is this something that I can do with? But ask the questions rather than just insisting that that's how it goes.
I just want to focus on those couple of tax things there, because I get that day in, day out. Yeah, especially with my buy-to-let landlords. My daughter nu naam, Sunil nu naam. So this is a key one, and it's a question for you, Suresh Pai, I think. You mentioned about taxation, what types of taxation, especially in this scenario. And the other thing, Suresh Pai, I want to cover is, we talked about gifting to charities upon death, but when you gift while thar karavi ke, we do a lot of charity giving now. Is there any tax benefits or?
Well, there is from an income tax.
Okay.
If you do it on while you are alive, that goes against your income tax, provided you're a taxpayer. So that's where this gift aid and all that comes in.
Okay.
Now, just to add on to what Sangeeta Ben was saying, if you pay more than 10% of your estate into charity, then the rate falls from 40% to 36%, I think.
Wow.
Yeah. So that's another part of planning if you want to. So if you decide, at death, you want to give over 10%, it has to be over 10% of your estate to the charity, then your tax rate actually drops to 36%.
But this is why we're saying that there's, like with lifetime gifts, there are, it's the same thing with charities, there are terms and conditions, which is why I say, so even with that 10%, what constitutes the 10% is very different, because you've got the general estate, then you've got the, you know, trust-based estate and all the rest of it. So you really do need to take care. And what you were saying about the lifetime gifts, so I mentioned, if you're giving it to them, potentially if you survive 7 years, then inheritance tax na bharu pare. But Suresh Bhai will say, okay, right, 3 divas ni andar, you need to pay capital gains tax. Because it's an investment property, you've not lived in it, you've gained a profit because dame 1 lakh ni li diti in the 1970s, and now it's worth £1 million, so you've made a profit of £900,000, which is typical for Kensal Rice and Willesden-based properties. So therefore, you need to pay 28% tax. So when we say there's terms and conditions attached, the idea is, this is why it's so important to go to an advisor, because there is little point in you saving on one tax liability only to then increase your payment on another, you know. And then if Ganbhai and them are relying on that, where are they going to get? And the thing is, even if you're not getting paid for it, so if Pritesh is getting this buy-to-let property, even though he's not paying mum and dad for that money, for that property or the rent, mum and dad still have to pay that 28% capital gains tax.
Yes.
So so if we go back to the inheritance tax liability, one of the slides will show how it's usually calculated using the typical allowances that I've mentioned. So we're saying that they've got a net estate of just under £2 million, and I've taken off all the reliefs that in a typical scenario will be available to them. So we mentioned the nil rate allowance of 325. Now in this scenario, what I've done is I've presumed that irrespective of who dies first, Lalji Bai or Ganbhai, the assets will go to each other. So as I said, spousal exemption applies, so there's no tax on the first of them dying. The tax liability is calculated when they both pass. And if they've got a collective estate of just under £2 million, then what happens is, let's say Ganbhai died last, Lalji Bai passed first, okay? So Ganbhai's allowance of £325,000. Then there's something called the transferable nil rate allowance. And what that is because Lalji Bai gave everything to Ganbhai, his allowance was not used. And so the children can make use of it on Ganbhai's death. So they've made use of both parents' allowances. And the same goes for the residential nil rate ban. That's also transferred. So you're making use of both mum and dad's allowances, giving you £1 million tax-free between mum and dad. Okay? So what it is, that on what you're then being taxed on, the 40% is the 950 that remains, and that gives you a whopping tax liability, inheritance tax liability of £380,000. Okay? Now that's obviously still a huge amount, because if we look at what the assets are, the children have to come up with a way to pay that. One of the ways is to sell one of the assets, or to raise mortgages and to do all sorts of that they can, okay? But there are a few options out there, some of which have to be...
Sorry, how quick do you have to pay this? £380,000?
So it depends. It depends on what asset you're paying the tax on. When it comes to a property, you can agree payment plans with HMRC that can spread over 10 years. Usually that's not something that I advise my clients to do, because it gets expensive, because you have to pay interest on it. You can take out inheritance tax loans and things like that. But when it comes to cash in the bank, they will want that immediately. So the HMRC, if you've got I think we had about £80,000 in cash in the bank. So the HMRC will say, okay, whatever's due on that, that's fine. The property we can wait, but they will want a periodic payment each year, and you'll have to pay interest on that on top. I think at the moment it's 2.65%, but when the economy is working well, it's typically around 3%. Okay? So the other ways in which we can try and, for Ganbhai's and Lalji Bai's specific scenario, the way in which we can try and reduce that liability even more is, we mentioned in their asset portfolio that they have life insurances, okay? Now, I typically left that quite brief, because one of the ways, a lot of things that people will do is they will take out life insurances and then they'll just leave them. Say, oh, you know, when I die, I'll have a life insurance and that's fine. If you put that life insurance in trust, and it's not very complicated to put it in trust, the actual life insurance company does have the documents ready. It's literally just signing, nominating a couple of trustees and nominating beneficiaries of that life insurance policy. Then in the same ways that pensions falls out of your inheritance tax liability, that £300,000 that Ganbhai and Lalji Bai have collectively in life insurance can also fall out of the inheritance tax. So what that means is that when you come to me and say, Sangeeta, right, this is mum and dad's assets, I don't actually have to include that in their inheritance tax returns for the calculation of inheritance tax. So that's £300,000 on which you don't have to pay 40%. The next one is business relief for LK Interiors. Now, a lot of us have some sort of company asset, okay, which is absolutely fine. Now, but if that company is typically what is known as a trading company, and again, a caveat, there's lots of terms and conditions that apply to this, okay, but if we can declare that the company in which you own is a trading company, so it is a construction company that trades, you know, you do building and you get money in and out, then that is going to be 100% tax-free as well. So that's another £250,000 that we've taken out of them. This does not apply to the companies that you set up for rental investments. So if you're buying your property through a company, you will not get this business relief because it's not a trading company, it's an investment company, all right? So there's a specific there. So you need to come, if you want to work to building a business investment, then you need to come and speak to advisors about how we can get that going, okay? And typically, Harish Bhai will no doubt at some point, you can explain as well, that there are investments out there that can also qualify for business relief. So you can actually invest in certain stock portfolios that can qualify, and you can get that 100% tax-free as well. Did you want to talk about that?
Yeah,
quickly?
briefly, yeah.
Yeah.
So again, if you're trying to mitigate inheritance tax, so if you've got ISAs, for example, or cash, you can invest into business property relief investments. And typically, if you hold them for 2 years, after 2 years, they're exempt of inheritance tax, but you have to hold them until death. So in Lalji Bhai's and Kanbai's scenario, let's say they invested the £80,000 they had cash in the bank into a name portfolio, a business property relief portfolio. After 2 years, it's fully exempt, and they still have access to the money should they need access. And also, if they do need access to the money, there are things called discounted gift trust and loan trust, which can reduce the inheritance tax liability, but still give control of or access to the money that they want. Because a lot of individuals I speak to, they don't want to lose access to the money. They don't want to give it to their children because they'll think they'll just blow the money somewhere else. And so there are ways, and again, like Sangeeta Ben said, is taking professional advice, and she can talk about the inheritance tax side of things. And then if it's a financial advice matter, then we can work together and help
exactly.
get
Typically,
situation.
if you've come to me for a will, I have an obligation, obviously, I will be speaking to you about inheritance tax. So then I will say, okay, if I need to go and speak to Harish Bhai because we can't reduce tax on these liabilities, see if you can convert that investment into something else that will give you a reduction in inheritance tax, okay? But it's obviously finding a balance on what works for you guys. The other thing that I want to talk to you about, and this is really a very special tax relief that's very limited to almost our Asian community, because there's only 4 agreements that the UK has with this. The UK has agreements with only 4 countries in the world whereby if you are domiciled, and I'm not going to go into domicile because that's really complicated, but if you can prove that you have Indian origins and that you have links, strong ties to India, okay, then what we can do is we can say you have something called a general domicile of India, okay? And if we can prove that, then any assets you have in India, because don't forget, I said that they will want to know that Wadi and that plot of land and, the Makan in Madhapur or wherever it is, okay, they will want tax on all of that. If we can show them that you actually have general domicile in India, then any Indian assets that you have won't get included in inheritance tax. Okay, it's quite a complicated relief, but it means that typically, for example, my family, at least up until my dad's generation, I will be able to show that any of my dad's assets will be free of inheritance tax that are in India because he was domiciled in India, right? The typical way you will show that is A, by having assets. Maybe you've got family members there, you regularly visit India. So, when our parents and grandparents visit for 2 to 3 months, as much as we may hate it for childcare, it's really good because they're saving you on inheritance tax when they come back, okay? So, and the reason why I say it's really typical, why it's really niche, is because there's only 4 of those agreements out in the world. The UK doesn't have this agreement with anywhere else, okay? Everything else is to do with double taxation, where you get discounts for tax that you've paid in other countries. Here, whatever India has just doesn't get included here, okay, in broad terms speaking. And the key is, at the moment, as far as I'm aware, India doesn't have an inheritance tax or an estate tax duty. So that means that I could inherit my parents' assets in India without actually having to pay tax in either jurisdiction, okay? That doesn't apply for income tax and capital gains tax. that you do have to declare, okay? But for inheritance tax, that is a really niche area that all of us should or could be taking advantage of. What that does mean is that people like me who don't go as regularly should probably start going to India regularly, so that my children can benefit from this as well, okay? So
Sangeeta, just a quick question. You know the inheritance tax, that's paid by the inheritant, be it the children. But what if it's not their children? What if it's like the next door neighbour?
So the tax, so we say chokra and paru parse, but it's not actually the chokra that are purring, it's basically the estate. So when somebody dies, there's a limbo area where the money is held in the state or in a limbo time. And what's actually coming out is that tax is paid out of their assets. So it's not like when your mum and dad pass, they're not going to say, okay, dina money atla up. They're going to say, give me this much money from mum and dad's wealth. So they're going to say, I don't care how you raise that money, but give me the money from mum and dad's wealth. Typically, we tend to merge, and so, for example, I might say, well, I actually want to keep my parents' house because I quite like it, so I'll just take money out of my pocket and pay for it because I don't want to sell that property or I don't want to remortgage it. But it's not you that's having to personally pay, it's your parents' assets that have to pay for that wealth.
Okay, and how would they know that we've got that money? Or it's going to come?
Because you can't transfer it until you do a tax return. So when somebody dies, in order for you to transfer assets into your name or the beneficiary's name, you have to go through probate. In order to go through probate, part of the process is you have to declare somebody has passed. The only way you can get that probate certificate from the court is if the court is satisfied that you've dealt with the inheritance tax.
Right.
So inheritance tax has to be dealt with
linked,
first, and then So it's very
linked.
so. Yeah,
you can't just change the accounts into
no,
your name
I have
like,
clients
pay the
that will
tax.
come to me now. Bappa has passed 30 years ago, and they haven't done a tax return because, or because they just thought it was in Baran Bappa's name, and they didn't realize what was going on. Bappa didn't have a will, and now I have to do a probate return for Bappa having passed 30 years ago because they never got around to dealing with that. Okay. You lose all the benefits, you lose all this, some of the reliefs that were there, and you just lose out on so much, and sometimes you end up having to pay more tax than you would have had to otherwise. Yeah.
Right.
So just going back to what we've said about this, if we can make the life insurances be left in trust, and we can say Laljibai and Ganbai qualify for business relief and this double taxation relief, then potentially that's another £650,000 that we've taken out of their estate. Okay, so the only amount that they're now having to pay 40% on is £300,000, and so we've reduced their tax liability to 120. So what we've done is by just taking advice, proper advice, and applying the proper reliefs, you've reduced Mum and Ganbai's and Lalbai's estates tax by, I think, £260,000. Okay.
I don't think a professional is going to be charging £260,000.
No, exactly. Yeah,
right?
I'm not going to lie.
Look at the difference in your tax
look,
bill,
a professional is not cheap. If you're going to get
No.
the advice and you're going to do this right, I think collectively between us, none of us would profess ourselves out to be cheap and cheerful. But at the end of the day, I'm not going to be charging you £280,000. You can pay me £280,000, no problem. I don't mind.
260, right?
Exactly. Okay, and so you can see the benefit in seeking advice, because likelihood is that some of you out there listening wouldn't have known about this. Okay.
Yeah.
The other thing, and I think this is where the children, ultimately, as Dina says, even though it's not the children paying, it just means that the children inherit less. Okay. Now, if the children inherit less, then it's in their best interest to try and help mum and dad mitigate their assets or make sure that their assets are tax efficient for inheritance tax purposes. And one of the ways that I do this is I kind of back my clients back to people like Dina and Harish in terms of whole of life insurance. And the reason why we do that is I will say, okay, mum and dad are at this age, go find out from Dina and Harish how much life insurance they can get. Can they get enough life insurance to cover them for that £120,000? Typically, they will come back and say, okay, the premiums are, I don't know, given that they're in their 60s, maybe £300 a month.
Yeah,
okay, typically are £300 a month.
Yeah.
You've got 3 children who are going to benefit from this life insurance if it's put in trust. Okay, so if each of them pay £100 a month towards these premiums, okay, they're potentially going to get the full £2 million without actually having to pay that much, because you pay the premiums over a period of time. It's monthly. £100 a month is not that much if you're earning and you have a decent income portfolio. On top of that, the amount that you're likely to pay, so mum and dad will live, another 30, 40 years? The amount that you're going to pay in premiums is not going to be this up to £120,000, okay? So yes, you've paid a little bit, but you've paid it in bite-sized sums, which is actually more affordable. And at the end of the day, the HMRC get their money and you get the entire estate without actually having to do much faff at the end of it. So it's really important.
So I'm just going to talk about that briefly. Harris, you might want to add in. So what would actually happen is, in this scenario, the children actually become my clients. They become the owners of the policy, right, Harris?
Yes.
So, but we're not actually insuring the children. So when we were taking British's and Tulsi's life insurance, we were insuring them. In this scenario, we're actually insuring the mum and dad, okay? But we're not insuring them each, because it's not 120,000 each, right,
No.
Harish?
Yeah.
So I'm going to hand it over to sort of talk about how the insurance quickly works,
Yeah.
and then where that money will actually go.
Yeah, so the whole of life policy would just simply be set up on the liability that needs to be paid. So it would be set up on usually second death of Laljibai or Kanbai, and the policy would be set up into trust. So when the proceeds are paid out, they'll be paid out to the three children.
Yeah.
And then they would
And
use
it's
that
joint cover, isn't
joint
it?
cover,
So it's
yeah.
when either one of them,
Either, yeah, and
second death.
yeah,
right?
second death, and then they would use that money to pay HMRC.
Yeah, there you go.
effectively.
So actually, then you're not taking anything out of the estate or having to find the money.
And it's
because
probably
insu-
quicker as well to get everything sorted out.
Yeah,
you know.
absolutely. Because anything that's written in trust, I think Sangeeta Ben said, it gets paid out, you don't have to wait for the whole sort of process of probate, and it's outside of the calculation. So that 120 won't come back into the assets calculation that Sangeeta was referring to earlier.
Yeah, and I think it's just really, really important to stress that you just seek advice.
Yeah.
So even if that is, as I said, going away, paying somebody to give you a consultation, you don't necessarily have to walk away with a piece of paper or some sort of product, but you've got advice to understand how your assets work and what your liabilities are and what you may do. And some of this you might not implement immediately. You might implement it later. Like Laljibai and Kanbai, some of this I will say implement it now. But for example, British and Tulsi, their kids are young, so they're not going to pay. They're not going to get a whole of life insurance for inheritance tax purposes, but now that they know about it, when the kids are perhaps 18 or in their 20s, they'll come to you much earlier to say, right, let's get mum and dad's assets
Talking about
sorted.
this. Yeah, absolutely. Absolutely. So we've talked about saving money, pensions, paying tax when we die, but we haven't talked about the type of tax we've got to keep paying while we're earning our wage, selling things, be it our assets, be it our shares. Was there a question?
We've got one question. So I mentioned earlier that there's 4 countries only which the UK has this agreement with, and so we've been asked if Kenya is one of them. Unfortunately, it is not. In terms of the sort of countries that our community deals with, India is the only one. So Kenya's not, USA isn't, Australia isn't, Dubai isn't, Cyprus isn't, none of those countries are.
So in the next 24 hours, all that money in Kenya is going to get moved to India, right? So might want to start planning that, but let's do that legally and do it the right way. But yes, these are things, now you know this type of knowledge, you can start planning going forward, right? The best things. So was there any more questions? So I was just talking about tax while we're alive. There's a lot of tax, and commonly everyone says, "Mane tax nati bharu. Tu kar, badu kar, but mane tax nati bharu." Now, we're going to refer back to Suresh Bhai, so I'm sure that's a mantra that you hear all the time, right?
Well, I think nobody likes paying tax,
Yeah.
but it's something that we have to do.
Yes.
Right? And one thing you have to remember, you only pay tax if you made money. So you can't pay tax if you've not made money. So I think that's an important thing to understand.
Yeah.
It's not something that's taken out of...
It's a good thing.
Yeah, it is a good thing.
Because you've made money, right?
In a roundabout way,
Yeah.
if you're paying tax, that means you're doing well.
Yeah, absolutely.
Right?
Yeah.
And I think with tax, the taxes that are relevant when you're alive, really, are taxes like income tax, your capital gains tax. And in our scenarios, there's a couple of taxes which play in, which is income tax and capital gains tax. And I'll explain to you roughly what, what can be done. But first thing we need to understand is what is tax avoidance first. Because one of the things that there's tax avoidance and tax evasion. Now, avoidance is walking the line. If it's avoidance is when you're involved in bending the rules. You're not necessarily breaking them, but bending
Illegal
them
activity,
to take advantage that the government really never really wanted you to do. So it often involves things like artificial transactions and contrived transactions which serve no purpose really. So I think we've got to, whatever we talk about today, you've got to understand that the purpose for why you're taking certain action has to be commercial, or there's a rationale behind it, not just tax. So it's not done really purely for tax reason and say, well, actually, I'm going to do this, although somebody doesn't work in the business, I'm going to call it a salary for them, or I'm going to, to contrive it in such a way that it becomes an expense. So that's something you've got to understand. Now, looking at our I know we're running quite low, sort of close to time. The few things that you often find with companies is that they are left in the way they were set up originally. So you find that if Laljibai had set his companies up 15 years ago with his son, it's still the same. But then now, his daughter-in-law started working in there. The other son might have been working in there. But the share structure and the remuneration structure still left behind as if he was the only person working in there. So the few things that they could do is things like making sure that the structure is up to date. So the other sons, if they're brought up to date. So now, when you look at the slides in front of you, you find that if based on just the two, Pritesh and Laljibai, earning £9,000 in salary and 40,000 in dividends, the total tax due from them is 9,900 and 2,500 from Pritesh. Yet if they were to share it between the four of them, the tax burden actually drops much lower. There's a potential saving of 7,800. And all that is to getting the structure right, more up to date.
Yeah.
We're not saying that, bend it, but what we're saying that actually review the structure.
Yeah.
So I think that's something that's often forgotten. So one of the things they need to do is continuously reassess where the business is, and that's where the individual accountants would come in place.
Right.
They just need to make sure
succession
that
planning,
succession, and also
really?
looking at what's new.
Tax is
what's
changing
changed.
all the time, isn't
That's
it?
right.
Really, with COVID, taxes have changed, benefits have changed, grants have changed, and clients need to be in dialogue with their accountant, not just that once a year when you're handing on all your bookkeeping.
Just to get your tax return done.
Yeah, exactly.
So I think that's one thing that Laljibai and his company perhaps could do is just look at the structure, and if it's somewhere they can actually bring the other sons or the daughter-in-law in it, there's a huge tax savings to be made.
Okay.
The other thing which is relevant to all of them really is the management of their limits. Everybody gets a tax free limit every year. And every year there is a tax-free limit of 12,500 personal taxes, and there's a higher limit. So over 50,000 earnings, you go into 40%, and over 150,000, it's 45%. But there are certain things when you cross those limits that taxes become payable, and you start losing things like your personal allowances. So if anybody, for argument's sake, goes over, say, the £100,000, then, and if they start earning another 120,000, on that 20,000 alone, they lose £10,000 of their personal tax allowance.
Wow.
So you lose, for every £2 you earn, you lose £1 of your tax allowance. So somebody earning £120,000 should possibly look at either charity payments, pension payments, and the resulting tax rate there is about 50%.
Wow.
So you gain almost 50% by investing in £10,000 worth of payment if your earnings of £120,000.
Yes,
So
you said you were talking about keeping it up to date and always talking to the accountant. One of the common ones, actually, I think I was talking to one of my Monday colleagues, funny enough, and child benefit.
Yes.
So when the child's born, they've got this £80, £90 every month, but the earnings are increasing, right?
Yes.
But they're still getting this £80, £90. That's a common one, right?
That's the common one.
Yeah.
With child benefit, you're meant to give it back as soon as you start crossing the 50,000 earning. Any one parent
Right.
So this is where it's a little bit unfair, the tax here. So if say two people, husband and wife, both earning £49,000 each,
Right.
they won't have to give up their child benefit.
Right.
But if one parent is earning £70,000 and the other earning nothing, the £70,000 would have to give back the full tax child benefit that they received.
So sometimes you've got to think about that pay rise, right? Whether you should take it or not if you're on that that boundary.
It's pay rise,
Yeah.
or you start thinking about pensions. So if
Yeah.
again, any money you put in pension,
Yeah.
it increases your basic tax limits.
Right.
That by bringing you within
Yeah.
the higher rate,
threshold.
the benefit charge that might
Okay.
apply. Same thing would happen on the upper threshold. So if you're over crossing of 100,000, certainly think about charity payments work the same way as pension. Charities, pensions, and there are others like EIS schemes and VCTs, which, but they're high risk. So it depends if you like that kind of risk. But they are also tax efficient ways of actually.
There seems to be answers out there to everything, or solutions, isn't it? It's about knowing that solution or finding the professional who understands that solution, and then actually taking the action to take that put the solutions in place. Right?
We do have a question.
Yep.
Suresh, this is probably more for you. Are there any taxes or tax liabilities for making gifts to grandchildren?
From grandparents to grandchildren, if they're minors, there is no tax liability. But parent to child, a minor child, it'll be treated as if it's the parent's income. So from grandchildren from grandparents to grandchildren, no, that there isn't it doesn't get hit back. Yeah. But from parent to a minor child.
We've got the guys there just laughing because they're all kind of like, let's go raid granny and grandpas.
So, but this is only for minor kids, yeah. So once your kids are over 18, it doesn't matter. So so that's the answer to your question.
I think from an inheritance tax point of view, the tax liabilities of the grandparents, so it doesn't matter who the ultimate beneficiaries are, save for when it's a residential neuro ban. But typically, no, there's no difference in tax liability because the tax is based on the grandparents as opposed to who the beneficiaries are, whether it's the children or the grandchildren.
There's some things that people might do, that the grandparents, they might pay for the private school fees, the nurseries, or the private care. A lot of children are going to private schools now. So that could that work?
Yes, it could work. And interestingly, it could work on many levels, even at Sangeeta will tell you, even on IHT level, because if it's a regular thing they do,
right,
out of their surplus income,
right,
then that falls outside your IHT tax liability.
So guys, get your parents to pay for your children's swimming, all their activities, nursery fees. That's
maybe spend a few more Saturday, Sundays there. We call them over for dinner a little bit more often.
I think those are things that should be done if it can. I mean, I'm not saying you should give up if it's not out of your.
No. It's got to be within your means,
within
right?
Your means,
yeah. I suppose you're getting them to pay for it, but then they're going to India, so it sort of works. They get to go to India for about 3 months, right? Enjoy, but they're also paying for your children to go. I'm not quite sure. It's going to be a difficult one for us to convince our grandparents out there. I think we've got some difficult conversations.
I think, where you've got grandparents, you've got like 13 grandchildren. Right?
But talking about difficult conversations, I think our community, we don't necessarily talk about wealth. We don't necessarily discuss intergenerational planning, because it's like, you don't talk to your sons or your daughters or your colleagues. And I think it's key. You've got to have these open conversations, and each, in British's case, he's got his objectives. Lajibai's got his objectives. And you have to sort of marry them all up, right? To then plan as an extended family.
Yes.
And that's, I think, a big message we want to get out there today, is do have those discussions. Our parents don't want to talk about, or and they don't need to know the amounts, but you need to know you need to start planning, right? Sangeeta, we're going to talk about the wills and that. Sorry, Suresh, bye.
No, that's fine. So, I mean, the other question, which is regularly asked, is buy-to-lets, and whether it should be a limited company or personal. And that's a big question, and I'm sure all of you would be asked that at some point. And there is no short answer.
No.
And it depends on every individual, depends on your intentions, depends on how long you want to keep that property, depends on whether you want to occupy it. So all these questions need to be answered. Yes, there is a tax benefit of the company having owning the property, a buy-to-let within a limited company, but it can be expensive if the intentions are that either you're going to occupy it, it's not going to be there for long term, because in this instance there is an instance of double taxation. One, you'll be taxed as corporation tax, and one, an exit when you want the money out. You'd either pay capital gains or dividend tax. So when you add that together, you might not be any better off.
Yeah.
The other thing is that if you're a low rate taxpayer, you're not much better off. So why would you want the
Well, the rates are more expensive.
Exactly, and
accountancy fees that you've got to pay for returns.
And the compliance of a company.
The compliance of the limited company,
So that conversation, really, they must take with their accountant. On the slides, there are pointers, what they should be bearing in mind. But those are the sort of things. So it's not a sort of an easy answer to give,
it's not
because it's very
cutthroat,
individual.
is it?
No,
Yeah, absolutely.
it's a very individual answer, right?
Yeah.
I think the other questions we in our scenario is that we were looking at perhaps getting one of the sons onto the property ladder. What potentially Lalji Bhai could do if he's planning to give his buy-to-let property.
Yeah.
If it's a gift, there's still capital gains tax, even though it's a gift. There might be savings on the stamp duty land tax, but there is still capital gains tax to pay.
Just by adding
But just by
right?
gifting it away,
Yeah.
you still have to, the transaction has to take place as if it's at a market rate.
Right.
So at today's, even though there's no money is exchanging hands, so Lalji Bhai would have to pay capital gains tax on that.
Right.
And capital gains tax on property is at, if it's a lower rate taxpayer, part of it would be the 18%, but by and large is 28%.
Right.
Gifting or giving away shares, the capital gains on shares is either 10% or 20%, but in Lalji Bhai's case, probably 20%. Yeah, so that's the capital gains tax. It's something that that could be looked at in tandem when they're looking to gift things away to the kids or helping them start off.
Do you want to talk to maybe just for a couple of sentences about, India my FDR's fixed deposit ni interest yave?
Yes.
Oh, okay, joto vecho.
Yes.
Because it's no longer viable or something.
Yes.
Like, is there a tax liability here? If it is, what is it? Because it's in India.
Yes. Well, I mean, in UK, if you're a UK resident and you've been a UK resident for a while, it's your worldwide income that's subject to tax. So that interest you're earning in India has to be declared in UK, unfortunately. And many haven't. And over the last 2 or 3 years, HMRC has been picking up on those. And there are facilities available in the sense that HMRC has set up a worldwide disclosure facility where you can actually go in and report those. If you haven't done them for so many years, you can go in and report that income and pay the tax penalties, then you're clean. So the short answer to your question, yes, you have to declare it because you're resident in this country. If there is tax paid in any country, there is double tax treaties with most countries. So you won't double pay the tax, but also you've got to be careful. The situations I've come across where taxes paid in another country are much higher than the cap that has been allowed under the double tax treaty. So you might lose a little bit there.
And I've noticed with my clients that because we were talking about earlier about institution sharing, it's not just UK institutions, it's worldwide institution sharing.
Yes.
So I've had clients who have had notices saying, oh, we believe that you have an asset over abroad, would you like to declare it?
Yes. Well, those are the letters I'm talking about because they've been going for the last 2 years.
Yes.
Yeah.
And it's very easy. So, when you start up your account in India, they'll have taken your national insurance number. They have your passports. Very easy to tie up. In this computer day and age, you just need to run a report.
Your national insurance number.
Yeah.
That's what, when you die, they ask for it. When you buy a house, they ask for it.
Exactly.
The minute you turn 16, that is like your power number.
Yes.
So when you go and open up your bank account, it's asked for.
So the question is, when khabar nahi pade, that's, I think, it's no longer relevant.
Absolutely.
So we have a couple of questions or comments here. So one being, this one's probably for me, IHT after tax relief, if it's shared between 4 siblings, full 40% needed to be paid, then is it a split or is there some relief per sibling? So as we discussed, the tax that's payable is not by you who's inheriting it per se, it's the tax that's payable on the asset. So it's actually paid on mom and dad's estate. So there's no, oh, okay, split career, split career, it's going to be what on that 1 point, the calculation is going to be on that 1.9 million that we discussed, and it's going to be whatever it is, irrespective of how it's split. So there's no extra release.
So in that scenario, that 120,000 would be
typically the 3 brothers and sisters could say, okay, what labhar on the premise that they do it. There is a question here about wills, asking about when is a will to be reviewed for tax planning. We are going to, I know we're running a little bit late and we do apologize, we did have some technical difficulties earlier, but I will be touching on wills quickly before we sign off, so I'll talk about tax planning then. And we do have this conversation, and I think all of us will agree that we do have clients like this. Is someone's made a comment to say, sometimes levels of wealth are never discussed because it can cause other issues, but when should conversations be made with potential beneficiaries? Now that is, I don't know about you guys, but from my point of view, yes. When someone comes to me like, there is that there, and that is very difficult. But I think you need to, if you're the one that's seeking the advice, speak to, my advice would be come and speak to whoever it is that you need to speak to for the advice, and then that person is probably going to have had experience of that scenario. So for example, when you come to me and say, I've had those conversations and very many other conversations with clients who want to keep it secret from perhaps one beneficiary, not the other. We can advise you on how best to approach that situation. Would you guys agree?
Yeah,
Yeah.
absolutely.
Yeah.
No situation is the same.
Yeah.
You know, we have that type of siblings situation. We have possibly sort of married couples separating, and you've got difficult scenarios there. And there is really no real right or wrong answer here. It's individual to those circumstances. So, you know, the thing is, you've got to have the conversation. You've got to plan. You've got to think as a family overall. But you don't need to start getting into specifics, right?
No, I think
So all I tell you is because we are professionals, everything you talk to us or tell us about is confidential. So it's not shared with anyone else. If you don't want us to share it, that's fine. But we are professionals, so we will treat you individually.
Yeah, and we are actually licensed, all of us, under the data protection and GDPR. And typically, I'm sure we all get it. And then they might tell each other the assets, but we can't tell we're not going to turn around and say,
I've had that when they come to me for wills. So I've had parents, 2 brothers, or lucky there.
Yeah.
But then I can't because I'm not telling you what they've written.
People
so you
try
need to tell
it.
me. Yeah,
People
but then they go away and have the discussion myself, and then they'll come back to me. That's fine.
Yeah.
But just because your parents are coming to us doesn't mean that we're going to disclose to you what your
What
parents
they've said
are
to
saying.
us,
Or if you've come to us and you have issues with your parents or your siblings, we're not going to then discuss that with them. If anything, we'll probably say, sorry, I'm conflicted. I can't advise you. Please go and seek advice from somebody else.
And that can happen. So when we're looking at intergenerational planning, if there is conflict, we have boundaries. So we may turn around and say, unfortunately, there's a conflict of interest. It may be worth you going to speak to another professional, which is actually far better, going forward.
Surya, was there something else that you wanted to add?
Well, I think the only things we've talked about, basically looking at your company structure, looking at your allowance structures, capital gains we've talked about. The other points that the company should consider perhaps is just look at the share structure. There's something called the alphabet shares. You get A, B, C shares. That helps some companies, that sometimes it doesn't. There is this super deduction at the moment. Up till April 13, companies are entitled to 130% of whatever they spend. No, it's a super deduction, they call it. So it's 130% on plant and equipment used within your business. So if you buy machinery, a forklift for £100,000, you can claim £130,000 from as an expense. So that's an important
very much so, because if you're thinking of growing your business,
Yeah.
this is the time to make those investments, right?
Yes,
yeah,
exactly.
yeah.
And
But it
that's
has to be in
available.
plant and machinery,
It has
right?
to be plant and machinery.
Okay.
Accountants will know, I mean, the business people will know, is what you used to get 18% capital allowances for.
Yeah.
Those are the pieces of equipment that you'll get super deduction on.
Okay.
Things to also look at: company cars, electric company cars, fully electric, 100% allowance at the moment for company cars. They have to be new, but there is benefit in kind that they need to just talk to their accountants about. Look at pensions. We've already talked about pensions.
Mhm.
Company paying certain kinds of insurance, like Keyman insurances, relevant life policies, which Harish Bhai has talked about. There's also availability of government grants and furlough, and all those should be revisited as a company. And that's something they should probably look at. I think we've talked about gift reservation and gifting to minor children. I think that's taken into consideration. So I think as a company, there's a few things they need to look at, and they probably need to sit with their accountants and consider.
Yeah, something along that is things like your shareholder agreement. You know, if something in this scenario happens to Laljibai, you know, is the wife just going to, everything goes to the wife and wife goes in and runs the construction company? I don't think so.
No.
So there's got to be something on paper, right?
Yes.
So Laljibai is saying, well, actually, but the wife, you know, what was the wife's name? I've forgotten her name.
Tulsi.
Tulsi. No, Kanbai.
Ganbai. Sorry, I thought you were talking about
Tulsi
British.
has to wait a bit. Kanbai is saying, okay, well, hold on, I want my money, right?
Yeah.
Laljibai construction company is worth millions here. So, but Laljibai is not. Where's he going to get the money? Where's Pritesh? Where's the business? LK Interiors going to get that money?
Yes.
So these are big questions that these directors in this scenario, Laljibai has to think, well, actually, I need to pay Ganbai off. Otherwise, Pritesh ne vyadi thai jayega. Ganbai avine, you know, will take over the, because she can, because she wants her money, right? And then profits can go. There's so many impacts on the business.
Also,
right?
importantly, if Kanjibai has got certain specialism, he's got to be replaced.
Yes.
So you need to pay for somebody to fill in his shoes until Pritesh is ready to
And you
take
can't
over.
train someone
You can't
overnight,
train
right?
overnight, exactly.
It takes time, you
So
know.
these insurances are there to
Yeah.
for that kind of things.
Yeah. So that would be the key person.
Key person,
Who are the
yes.
key people in your
Exactly.
business? You need to think of that,
Yeah.
right? Because sometimes it could be, you know, your daughter in there or whoever doing the bookkeeping. More so, it's like the finance directors,
Yes.
or when we're talking key people, it's your sales people who are actually bringing in the business, the people who are going to impact your bottom line profits, right? So, and I don't think that we have possibly looked at that. Because we don't generally review that. You know,
No.
dando taya rake, profit taya rake,
Yeah.
and we're very quite calm in that way, aren't we? Kare raki up there. So. Have we got a poll question out there yet?
I think it's already been answered.
Has it?
Yeah.
So we'd like to know the results.
Okay, so you were also asked, part of our polling, do you have a will? How many of us listening in have a will, Alpesh?
Only 29%.
Okay, so 29% have a will, which is typical of actually what the UK statistics say at the moment. And how many of you, perhaps some of you might not know this answer, but we also asked the question of, do your parents have a will? Some of you might not know, but for those of you who do.
53%.
Okay, so 53%. So your parents are a little bit more forward-thinking than you guys, which is a little bit surprising usually. All right, but that's fine. What I'm going to do is, I know it's quite a long session, so I do apologise. I know it's a Saturday night. Some of you have missed football to listen in. We're very appreciative of that.
I don't know if they miss football. I think the 53-inch TV's on with the football.
Do you think with
and
the
they're possibly-
laptop on the
Yeah,
side?
the
Okay,
laptop
fair
on the
enough.
side,
All right,
yeah.
then I'm
Yeah.
not sorry. No. So what I'll do is, we won't go into too much detail because there's a lot of information today, and you probably will forget it tomorrow morning. So if you do
They're
take,
not going to sleep tonight. They're not going to sleep tonight.
yeah, if you had the paper set.
Information overload.
But what I will do is I will just touch upon what a will is, why it's important, and why it's something that you should do. So the first question is basically, I think all of you know, but what is a will? And putting it simply, it's basically just a legal document that says, okay, when I die, these are the people that are going to sort out the paperwork, and this is who the assets are going to go to. And obviously it can get a lot more complex, but it's just a binding document that says that, okay? Now, why do I need a will? A lot of people think that they don't need a will. Now, some of the things that I like to say to my clients when they say, what I have to say is, without a will, there isn't certainty. So, then the government will decide for you. Okay, and it's not always necessarily going to be what you think it's going to be. So a will is about certainty, making sure that the people that you want to control the assets are controlling it, and also making sure that it's passed on to your beneficiaries in the way that you want it to be. So for example, if you say makan ane jawo joy ke khatu ane jawo joy ke dikro look after kare dikri na kare, that's not going to work if you don't have a will. You have to put it in. If you want to, I had a bapa who refused to do a will, but he said kone jawano chokra ne jaru nathi mandir ma jase. Yeah, true scenario. And I said, okay bapa will kariye. He hadn't done a will, jaru nathi. You know, so it's not going to go to charity. It will go to children and family members who you may not even want to benefit, okay? And also, as I've said here, it's just making sure that it's done in the right way, okay? Guardianship is something else that a lot of us younger ones don't know about, is that in your will, you can nominate guardians if something happens to both parents. So if you and your partner pass away and you have children who are under the age of 18, you need to nominate somebody to look after them if and when you're not around. Again, a lot of people assume, oh, my mum and dad will do it, or nana and nani will do it. Well, if you think about it, let's look at this scenario, yeah? Pritish and Tulsi, young in their 30s, Lalji Bai and Ganbai are in their 60s. Are they going to be able to look after 7-year-olds? Are they going to be able to look after that new one? Yeah, I know, for example, like our parents are all getting elder. They've got, arthritis, they're not going to be suitable. And if you've not nominated somebody in your will, there's every possibility that social services will get involved. And when social services get involved, it becomes a lot more formal. So therefore, they look at everybody, and just because it's family is around, they don't necessarily have to choose family, because if they don't think it's in their best interest, they won't choose family, okay? So that's one of the conversations that we have quite a bit. The other thing I want to quickly run by is common misconceptions about will. People assume a lot of things when they come to me about wills, these are a couple of the things that they assume, okay? Firstly, that if you make a will, then there's no inheritance tax to pay. Unfortunately, as much as I would like that to be a thing, because then that would mean more work my way.
That's what they all tell me.
Yeah, okay. Yeah, no, it's not. You can reduce the tax based on some of the way in which I structure a will. So, for example, we can do some clauses which will mitigate the tax liability because of the way you did it. For example, giving everything to Ganbai means that there's no tax on the first death. Okay, or giving to charities. These are the sort of things that you will have to put in your will. So there are ways in which you can mitigate inheritance tax, but the liability doesn't go away simply because you have a document that says this is my will. Okay. The other thing is anybody can witness a will. So there is, in order for the will to be binding, we have to have a specific process, and it has to be fulfilled, okay? And one of the things is you have to have 2 independent witnesses signing at the same time that you're signing. So, when Dina does her will, she'll sign her will, and then both Harish Bhai and I will watch her sign, and then we'll sign our names to say, okay, fine. And we saw her signing, and therefore she's the one that's done the will. Spouses don't matter. So, for example, if Lalji Bhai and Ganbai are doing a will and they're nominating Pritesh as the beneficiary, Tulsi cannot sign on her behalf, okay? And generally, when my clients are signing, I kind of say just don't use relatives at all. Either come to the office and come to me, use a neighbor, or use, friends at work or somebody like that. Avoid family altogether, because certain family members or spouses of family members will invalidate parts, if not all, of your will.
So, Sangeeta, those who are witnessing, are they reading your will then?
They don't have to know. So you don't have to tell somebody what the contents of your will is. You can just say, this is my will, here's the last page, can you please sign here and watch me? So
they're just witnessing your signature and it's you, right?
I mean, sometimes, to be fair, if you are going to get somebody like that, if it is feasible, obviously go to the person who's actually drafting the will for you and make sure that they're one of the witnesses. If you're going to their offices, they will always have somebody, like for example in my office I'll have an assistant or somebody who signs for you. If you are getting somebody, then it's probably better that they do know the contents of your will than they don't, just purely because then that witness is going to be the person that's going to say, right, this is what was in it, okay? But it's not necessary, okay? So let's look at if Lalji Bai and Kanbai didn't do a will, okay? So let's look at the situation, and this is where things go a bit haywire, okay? And so on the next slide, on this slide that you're seeing, I'm again assuming Lalji Bai passes first, and sorry to all the men out there, men do have a lower life expectancy than women, which is why I always use the men first, okay? If we assume that it was a 50-50 split of assets, okay? So Lalji Bai's name was 50% and Ganbai's name was 50% on the assets, okay? Then that means Lalji Bai's estate is probably potentially worth about £950,000, okay? So half of what we've been discussing so far. Now, as I said, Ganbai doesn't get everything. She gets his personal possessions, so she gets his kapra and karyal and chisonu, daginu hased, she'll get that, okay? But she won't get all the rest of it. So first, she'll get £270,000, okay? So out of that 975, the first £275,000 will come to her. Jibaki che, which is the £705,000, that gets split in half. Ganbai receives half of that, which is £352,000, and the rest of it is split to the children, is gifted to the children. Now we have 3 children here, so that translates as just over 117,000 per child, okay? So what we've seen there is, just because Lalji Bai didn't have a will, Ganbai doesn't get everything. Now, this might not be an issue for tax purposes. In this situation, it's not, because we can use the reliefs to make up that £352,000, but it's not tax efficient, because potentially on Ganbai's death, there's probably going to be a larger tax bill than 120,000 because we've used up the allowances on the first death, okay? But there's other issues as well. Firstly, where do we get the money from? How do we split the assets? Where do the children get their 325,000? What does she give up? What does she sell? How does she make that up that money, okay? There are potentials even with the children. Okay, 352,000 in a day. Let's say we give them the buy to let. How do the children then split the asset? Okay, do they want it? Does one want to buy the other out? How does it work? Now, if the buy to let, as Dina was saying, if British is saying, Mom, I'll buy you out of LK Interiors, then the buy to let becomes her only rental income. So then if that's the asset that she's having to then give to the children to make up this allowance, then where is Ganbai going to earn a living? She was a housewife. How is she going to pay for her retirement and her income? Okay, and we've already mentioned that we use up the allowances. Now, we can do some fanciful, networking and have something called a deed of variation. But in order for us, so what we do is the kids can say, okay, you know what, Mum, it's fine, Dad made a mistake, he forgot to do a will, let's do a deed of variation where we agree for everything to be transferred to you, and therefore there's no tax to pay on the first death. But the problem with that is, A, it's an afterthought, so there's an assumption that all the children will agree, okay? If Sunil turns around and says, sorry, I'm young, I need 117k to get on the property ladder myself, or Pritesh and Tulsi are saying, well, actually, we could really do with that money at the moment. They won't agree to sign that deed of variation, so she still has to find that money then.
And the thing is, that's not what Lalji Bai wanted, right?
Exactly.
That's the bigger thing here,
and the other thing is, unfortunately, we have had the past year, I know it's not come up much in our conversations, but we have had COVID, okay, and we have lost people earlier than we would expect them to, okay. We don't know when Bhagwana Bulawa Awanoche. So here we're assuming when it's 60, they've had the prime of their life and they're passing. But for those of you who know my family, we've lost members who are much younger than that, okay? Now, in that scenario, when you've got kids who are under the age of 18, right, they don't have the legal capacity to sign on that deed of variation. So even if at 16 they say, Mum, Dad, we don't want the money, you take it, that deed of variation is going to be no good because they can't sign it. And they're not going to get to 18 years in time for that deed of variation to work for tax purposes. So then it's pointless. So if you've got a 30 or 40-year-old man who passes, okay, and he's got, kids 10, 12 years old, the wife will have no choice but to carve out that money. Even if she's looking after it for them, at some point when they're 18, if they say, Mum, can I have that money that you were looking after for me when Dad died, she's going to have to hand it over.
Yeah.
Yeah?
Just on that thing, one generation down, the complication that will come is that, say, one of the sons is married, is divorced and remarried, and there's kids from each family.
Yes.
So you can imagine the complication it'll add to this situation if those children now also participate. See?
Which they would.
So that's right. They would be entitled under intestacy rules, right?
Yeah, exactly. So we've just had a couple of questions. Is cryptocurrency a chargeable asset in terms of IHT? Now, cryptocurrency is up in the air at the moment. For tax purposes, they are looking to legislate it, but short answer is yes.
Yes, so the short answer is HMRC is a chargeable, it's liable to capital gains tax. And under HMRC rules at the moment, they would consider it as part of inheritance tax as well.
Yeah, so they are, with cryptocurrency, they're looking to, at the moment, it's based, you've got an asset, and they treat it like an investment almost, don't they?
Yeah, it's just based on speculation. So if Elon Musk says, oh, I want Bitcoin is going well, Tesla, they will go up. There's no intrinsic value. So it just goes up because someone says, I think it's great, or I don't think it's great, and it goes down in value. That's how it works.
I know other jurisdictions have legislated against it a lot more, but I know the UK are,
they're in the process. They're toying in it. So cryptocurrency in the UK is not FCA regulated. It's not a regulated investment.
Yeah, so they're going to start.
But I think the talks are going in at the moment. There is motions. There's uncertainty whether it is going to happen.
Okay.
Because it's that intrinsic value, isn't it, how they're going to do that. But taxation-wise, you're going to get taxed. It's as simple as that, right?
So we have a question here. Can a will be made to assist one member of the family care or other costs and post their death then be affected in the manner that we want? So I'm not sure I fully understand it, but if I've understood it in the sense that can it be to a member, perhaps I'm presuming one beneficiary gets something more from the estate or somehow is
they're the primary carer.
I don't know. So it says, can a will be made to assist one member of a family, care or other costs? Yeah, so basically they just end up being a beneficiary. If they're not capable of looking after the assets themselves, so for example, if they're disabled in some way or you think that they're vulnerable in some way, then that's the sort of client I will be talking to you about trusts within the will. Yeah, so the way in which it doesn't mean that they don't still receive their inheritance, but the way in which they receive their inheritance is slightly different, and it means that somebody else is looking after them. And the second part of this saying, post their death, can it affect the manner in which we want? Again, that's where the trust comes in. So if you have, just recently actually, I did a will for a ma who's got one son, perfectly fine, normal in all sense and purposes, and who's got a daughter who is going to need round-the-clock care and is incapable of looking after herself. So what we've done for that particular client is the son will get his estate outright and manage it, but then what we've also done is the son and plus another person will look after the sister's share. The sister still will get her share, but it will be held in a trust where the son and this other trustee will look after it for the benefit of the sister. So, so when it comes to paying for her care costs, for example, okay, they will say, okay, fine, X needs this, so let's go and buy it for her, or let's go and pay for this carer, let's go and pay for that. So she wouldn't have the money in her own hands doing it, okay? What I do see a lot of parents wanting to do, which I don't think is necessarily the way I would advise them, is sometimes what they do is they come to me and saying, "Badu dikra ne de because e pachi sort out kar se dikri ne devama because dikri na look after kari sake." Okay, that's not necessarily the way to go in terms of if the only reason why you're saying that is because that she's incapable of looking after it because she's got a disability. That doesn't mean that you don't leave money to her. It just means that the way in which you leave it to her is different. Okay, so I wouldn't. Whilst we all think our families are great and we love them and we kind of say, okay, he'll know what he's doing afterwards, to leave the entire estate absolutely to one sibling on the premise that they will know or do what's right is really dangerous and it's really risky, and it's not something usually what I say. So I'm more about certainty and saying, okay, fine, you're worried about how she's going to manage, but there are ways in which we can do it.
I think, and also, the person, who the will is for, they can decide different percentages. There's nothing written in stone that it has to be equal, but they do need to have an open mind and make sure that what I feel everyone is looked after in the way they want their wishes, and also sometimes take away, like you said, the old school stigmas, like
we're in a modern society. There's no right or wrong. Actually, so you've got to think of that. So you've got to make sure that you're provided for long-term care. It's I think wills throughout all our conversation is a difficult one, because either people sort of turn around and say, that's a typical one.
Yeah. So just clarification, this question was mother wants to look after daughter, disabled daughter, but then split out her post-death. So that would be the trust that I'm talking about. So you could say, while she's alive, this money works for her, and when she dies, this is who the beneficiaries are. So that's very much the thing. The other thing I get a lot about is, it skipped me now. When I come back to when I remember, I'll come back to it. There are a couple of scenarios that I get when people come to me for wills and say, and obviously come and speak to us. We're more than happy to help, but I've just forgotten that question. So when I remember, I will let you guys know what it was. But I want to, whilst I'm hoping some of you are still listening in and engaged. The last thing I want to talk to you about is lasting powers of attorney. So what we've done today is we've split management of finances and well-being during your lifetime and also on death. And whilst a will is all about what happens on death, it's all about when I die, what happens to my assets. The other thing that some of us haven't considered and maybe need to start considering a lot more is what happens when I'm still alive but I can no longer look after my assets. Yeah, so my man 60 di bagrigi, so like if you're elder you might have dementia, or if you're younger you might be in an accident or something's happened to you where you are no longer capable of looking after the assets yourself. And in that situation, what you should be doing when it comes to discussing your wills or your finance planning is you should also be executing what's called lasting powers of attorney. Okay, typically our parents will say paranamo. All right, and that's basically a legally binding document which allows you to appoint somebody that you trust, somebody that you are confident in, to say that if something happens to me, I want you to then take over the looking after of my assets. Okay, and what that person will then typically do is go to the bank and say, okay, right, X person has lost capacity, here's the LPA, can you register it so then I can, pay the bills from this bank account or tell you to take money in and out and deal with like the the pensions company and all the rest of it, okay? Incidentally, if you want Harish Bhai, or in this scenario, let's say we've got Lalji Bhai unfortunately developed dementia, right? And he's got some stocks and shares which Harish Bhai is looking after. Unless you have an LPA, which specifically says, I want my financial advisor to carry on, Harish cannot do anything until a court order allows him to do so. Okay, so you really, and that goes for your pensions, that goes for stocks and shares, that goes for everything, and that also goes for your company as well. So you need to be executing business wills, because then if Suresh Bhai, for example, needs the signature of both directors, you're not going to be able to give it to him just because you're like, oh, ek director. If there are documents or legal documents which require both signatures, without an LPA where you can sign on behalf of that other director, you're not going to be able to go forward. And that's the same with buying properties as well, isn't it? Yeah, right. So there are two types of LPAs. One is for finances, which I've been discussing. Another is for health and care. The health and care is literally that. It's, cancer, what treatment should we get her? Because she doesn't have the ability to make that decision herself. And it can be as severe as, do we switch off the life support machine or don't we switch off the life support machine, yeah? Or it could be simple as, pay for the carer to come home. Yeah, that's the sort of things that a healthcare, somebody who's got an attorney, who's got the attorney on there, would be able to say that. Now, let's say Sunil, in this scenario, Sunil is a little bit brash, he's young, he wants to live his life. Unfortunately, we live in a society where he may not really care what happens. For him, it may be easier that mum and dad live in a care home, okay? Whereas British and Tulsi, maybe they're elder, they now have kids, so they're thinking, well, actually, if my kids do that to me, what am I going to think? They may say, no, mum and dad should get care for home, right? Now, if Sunil, if there is no LPA in place, you can see that there's a discord between the family members in terms of what happens to mum and dad's care. Whereas if British is appointed as the health and health attorney, he can make that decision to say, no, we're going to make mum and dad's money work, even if it's slightly more expensive than a care home, to bring that home to them. And the typical things that I put in, because you can put preferences or instructions within those documents, the typical thing I would say, like for example, roj mandire le jajo, or I like exercising a lot, take me to the park, or let this person visit me, or don't let this person visit me. Those are the typical things that you can put in there. So the next slide says, why do I need an LPA? I think some of my examples show you exactly why you need an LPA, especially in our scenario where you've got a business. I'm always telling my clients, execute a business LPA. Okay, because if we do a personal LPA, let's say we do a personal LPA where Ganbai is the attorney for dad, okay, because she can make that decision, and that's absolutely fine, no problem, right? But business ma, who's going to know more? It's going to be British, isn't it? Sunil or Maya are not going to know what's going on with dad's business. So typically speaking, she's going to have to execute a separate LPL that is specifically related to just businesses only, okay? Now, what happens if you don't have an LPA in place? Well, it's much more costlier because you have to go to court. The courts take a lot longer, so typically at the moment these sort of applications will take between 9 to 12 months, and that's on the basis that there's no problem with the application that you're making. It can cost about 3 to 4 times more. There's more potential for, at the end of the day, if here Laljipai, for example, would have chosen Pritesh to be his his attorney, he gets no choice. That choice is taken away from him. So any of them, it's up for grabs into who can be who then becomes the person who looks after your estate. And also, the order of the court doesn't go as far as the attorney does. So where the attorney, for example, you can buy a sell and property for them, right? If you're having to go to court, you then become what's known as a deputy, and then in certain situations you wouldn't be able to buy and sell the house. You'd have to actually go back to the court each time you're making those big decisions to seek the court's permission, which is obviously in the long term going to be a lot more costlier. I think we've had a few questions. So, okay. Ba gets kicked out of the house by daughter-in-law. Okay. Is there any assistance for her in the legal system? She becomes homeless despite having huge wealth. Well, to be fair, if Ba has huge wealth, then she's unlikely to have a problem because she's probably going to be able to go elsewhere. But the idea is that why would she get kicked out by the daughter-in-law in the first place? Because if she has taken the advice of all of the advisors that you have today, or some form of advice, then she's never going to find herself in a situation where somebody else has controls over her asset in that sense, where they're going to be able to say, okay, bye-bye. Yeah? So, for example, in this situation, let's say Laljibai dies and Kanbai is there, and Pritesh decides, okay, I don't want to move out, I'm going to stay because mom needs my help. I'm not going to be advising, and I don't think anybody else will be advising for mum to put Pritish's name on 100% on that property, because we're going to say, okay, but you still need to have security of your housing. So the idea is that it should never be in a situation, if she's taken advice, where she comes out where daughter-in-law says, okay, bye, and and if Ba has huge wealth, then that will never arise. But if it does, then if she's got wealth, she's going to certainly have assets to then house herself elsewhere.
Just going on to that, there's times where the sons come to me and say, oh, I'm going to be buying the house of my parents, and because they don't need to pay any tax. But I'm like, yeah, but I need to speak to your parents. And well, why do you need to speak to my parents? What's that got to do with anything? I'm your client, you're doing my mortgage, you don't need to do. And or a true advisor, a true professional would actually look beyond that transaction and think, well, hold on, what's going on? So all of a sudden, oh, mum can't come in. Yeah, it's okay, we can phone you.
So I've just remembered that question, that bit I was going to say. Yeah. So one of the things that I get when somebody says to me, come to will, like somebody typical for Kanbai and Laljibai, they'll say, Sangita ji maru declare karse ne ene atlo bhag wadhare. So they'll say, 3 bhag, 4 bhag gar. 3 dikrana ne dikrina ne pachi ek wadhu maro bhag. I'm like, how can it be your bhag? Because you'll be passing by that, you'll be dead, so you can't. Like now, ji mari declare karse ene malvo joy. Well, firstly, that's really dangerous, because what is define what you mean by care. Care can mean a number of things. Care can mean, oh, they live with me, or they look after me in the house, they cook my food and all the rest of it. Care can also mean, like Maya, she's a retail assistant, so she can take time off, and therefore she can take me to the hospital, right? And she can do the doradori for me. So that's also care, okay? So how do you define care? And what happens if none of the siblings agree? What if Sunu says, well, actually, I was looking after mum, and Pritish says, I was looking after mum. So those are the sort of clauses that I say to clients, well, no. If you want to give that, then there is another way we can do it, but that's not probably the way to say, ek bhag I didn't decide, okay? So we've had another one. that says if Ba passed all her properties to one of the sons she lived with, that particular son for years, okay, and later the son passed away, it says related question above. I'm not sure what that means, but if you have a situation where the beneficiary passes away, usually a good will writer will always have an alternative beneficiary. Okay, typically it will be the grandchildren. So for example, in Pritish's situation, if they give something to Pritish and Pritish is no longer around, typically his 2 children will benefit. Okay, so there's always going to be somebody, and then if Pritish passes, so if say Sunil passes away, he doesn't have any children, then Maya and Pritish could potentially split that share, depending on what you want to do. Yeah, I think that's everything. Unless anybody wanted to add anything else?
You know, with this subject of wills, there are so many different ways and questions that can keep coming in on it.
Yeah, I think so.
No, I was just going to say that, some of these questions are very important,
Yes.
but the important thing here is that don't let tax decide your fate.
Yes.
I think this is what's happening now. To save tax, we'll say, makan api do hamna, ke to tax per se. But then we come to situations where the bak will be kicked out. So those are the sort of things that your accountants, your tax advisor, your solicitors would say don't do that, even despite the tax. So I think sometimes you have to be more...
There's a balance to be had.
That's right,
there?
exactly,
Yeah?
yes.
Tax is all good and wealth, but ultimately, the way I say it to a lot of clients will say to me, Sangeeta, tax nati baro, inheritance tax nati baro. And I get that, I understand that. You've worked hard, you don't want your children, you want to pass on assets and you don't want your children to get it. But the way I say it is, tame menat su kam kariye. It's for your retirement. Bella, before death comes your retirement, okay? So, tame atli menat kari, and some of our parents have worked really, really hard, because some of us are second generation migrants, right? So for example, my parents migrated to the country, they weren't born here, okay, and I've seen how hard they've worked. So now that they've worked that hard, why all of a sudden, for the sake of tax, which they don't even have to pay, I have to pay, right, should they give up their lifestyle or their comfortable lifestyle in their retirement, okay, just because they want to then make things better for me? Great, thank you very much, love you mum and dad, but at the end of the day, the first priority has to be that it's their money and it works for them. And I think also what I find in our community quite a lot is that there's this expectation of rights. I'm the son, I'm the daughter, I have the right to this inheritance, and I think we need to shift away from that right. You don't have a right to any money that doesn't belong to you, because you're not the one that's worked for it. So if somebody chooses to leave that money to you, thank you very much. And if somebody else, like the taxman, has to take a part of it, no problem, okay? But ultimately, that money belongs to the person who's earned it, and ultimately it's for them to decide how and when that money is spent during their lifetime, and also how it's gifted over to the next generation, if that is what they want to do.
Exactly, yes. Yeah.
Sorry, I know that's a bit of a bummer, and if your parents are listening, some of them may say, okay, go in but
keeping all their houses to themselves now, making sure gadina muke. So I think we're pretty much done, unless there are any questions. It's it's late. I'm going to finish off with a quick summary for this session, which I think there's some key messages, really key messages here. One is plan, as simple as that. But you've got to split that plan up. It's got to be your short-term plan, your medium-term plan, and your long-term. And that's for anybody, whether you're over into retirement phase or Aparamachene, you've got the phases, Brahmacharya phase, you've got, Aparama 4 stages of life. It's no different in financial planning, right? It's absolutely, our dharma is absolutely linked to, this process we have to go through. So please do plan. Second thing, you can't just come to any one professional. It's got to be a very holistic approach. Clearly, in any of our sessions when we were discussing, we were bringing in each other professionals in, because we have our boundaries, and also you need specialist advice in your circumstances. Thirdly, what kaka, bapa, nana, nani, bajuwara, samewara, what they have done is not what you need to do. It's unique. Each advice is unique to each person. And I think that is it. I'm going to pass it to Alpesh Bhai and for his final words.
Jason, everyone, thank you for taking part in this session, and apologies again for the audience at home and everyone else watching on YouTube or on Zoom for the delays we had at the start. Hopefully with the questions that got answered, I know we overran in the end, but hoping some of the questions we answered helped you. But in the main message, just following up on what Dina Ben just said at the end there is, you know, the information you've got today is more for information purposes only. It's not, don't take this as personal advice. Some of the questions we've answered kind of clearly shows you that some of the situations are very specific, and you can't know the true context of those without knowing the full story. So everything we say here is for information. Even though these are professionals, without understanding everyone's personal situations, you can't give advice. So take this as tips and helpful advice, information, and gain professional advice if you need it for whatever situations you have. We had a lot of people on the call who never had wills in place, so obviously a lot of the stuff that we've covered probably is new to you, and you'll probably have to research a lot more, whether it's going onto Google or whatever that will be, to start your journey. I hope this helps. The one thing we will do to try and help with the beginning is we'll share the deck on the YouTube with the YouTube video so that you could see the first few slides clearly, and it'll probably help you follow the rest of the slides later on. So you might have struggled at the beginning with the sound issue, so hopefully the slides that we release later will help with that situation. Otherwise, thank you for joining. We have got other sessions that are running throughout the month, not to do with financial well-being, but other well-being sessions, which you're probably seeing on the slides now. So please take note of those, and we look forward to seeing you on those. Jai Swaminarayan. Good night.